Well, good afternoon, everybody. This is Sherry. I'm your host for today's Traders Exclusive Strategy Series webinar. We got 4 of the top items we're going to look at today is how option data, price and volume, can often be used to structure trading indicators, clearly defined risk/reward management, how the dumb money trades and how to not be one of them, how to use earnings to protect against unnecessary risk, and that's just the tip of the iceberg. I would like to direct you to tradersexclusive.com, where we regularly post articles, and video clips with valuable trading tips and techniques. This is also where you're going to find a recording of today's webinar. Before we get started, I'm going to share the quick disclaimer. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations presented here are subject to change at any time. Past performance is not necessarily indicative of future results. I'd like for you to please hold your questions until the speaker's done. Please write down and take notes and add a little context to it so we can know what you were asking about. Of course, if the speaker asks you to engage, please do. Our first speaker today is Lawrence G. McMillan of McMillan Analysis Corporation. He's going to be talking to us about what current option indicators are saying about the market now. And Mr. McMillan literally wrote the book on options trading. Options as a Strategic Investment is a bestseller published 35 years ago. It has now sold over 300,000 copies, and it's commonly referred to as the Options Bible. It's the first book people reach for when they are interested in truly understanding volatility and derivatives trading. He's been an active trader since the early 1970s. Mr. McMillan is widely sought after for speaking engagements and education. He edits and distributes a number of publications based on his firm's proprietary work and is often seen on CNBC, Bloomberg TV, and he's also cited in the Wall Street Journal, Barron's, and other major publications. Prior to founding his own firm, Mr. McMillan was a proprietary trader at 2 major brokerage firms, primarily Thomson McKinnon Securities, where he ran the equity arbitrage department for 9 years. Thank you so much for being with us, Larry. Now take it away.
Good afternoon, everyone. We're going to spend the next 45 minutes or so looking at these option indicators, which are pretty interesting right now. And of course, this is probably the most interesting market in maybe 50 years. So we'll take a quick look at some of the company. I started out as a derivatives research company 30 some years ago. We were selling data, recommendations, analysis, that sort of thing. But after 2008, when we were pretty successful in dealing with that bear market, people asked us to manage money. So we do now have a money management operation, both as CTA and RIA. And then we do a certain amount of option education, things like the webinar today. We'll come back to this later, but we are making the PDF of this webinar available on our website, and Sherry is recording it as well. And I will come back to this later about some special deals that we have on some of our products. So this is the general outline of what I look at when I'm considering what the market is doing. The first is the S&P 500 index. That's the most important thing. Your indicators need to line up with the market, or the market's always right, of course. Then we'll look at equity-only put-call ratios and individual stock and futures put-call ratios, market breadth, and then things involving the volatility indices, VIX and VIX Futures. So a very important rule to remember is that oversold does not mean buy. So we started down in January. We've been oversold much of the time between then and now. And yet it was never a good time to buy until perhaps just recently. And so you need to wait for confirmed buy signals even when the market is deeply oversold. There's a second rule, or a companion rule, and that is overbought does not mean sell. For a while, we didn't have anything that was overbought. Now we're already starting to get a couple of things that might be overbought. So this rule will probably be coming into effect in the next few days or so. So here's a 2-year chart of the S&P. and it's because I couldn't quite get the March lows on this graph, but the market had been off 35% from its peak in 2020 at the March lows. Then we rallied strongly since then. We really only had a couple of minor corrections. There was this 10% correction in September 2020, an even smaller one in September of 2021. But now we've entered into this severe downturn, a true bear market, where we're down 24%. By the way, to me, the percentage doesn't define what the market is doing or its classification. A bear market is one that's making lower highs and lower lows, and that's certainly what this one is doing. So until it stops doing that, this is still a bear market. However, we have been looking at a number of oversold conditions along the way. So this is a 1-year chart of the S&P. Zoom in a little bit closer. The blue lines are the downtrend lines that define the bear market, but the green numbers are oversold rallies. So bear markets are dotted with strong oversold rallies. And we're in the midst of one right now. I still have it in red because it hasn't finished going up yet. I'm not even sure where it's going to, but we're just about right here right now. I think 39.60 or something. And the one like target that I kind of see here is this gap that's still in the chart right there, that gap which fills at 40.17. Then this area right here is going to be a problem if it does get that high, because a lot of work went on there. A lot of people bought there. They thought the market was breaking out, so they'd love to be able to sell there again. That's what creates resistance if we can get back up to that level above 4,100. So just to sort of summarize that, recently we've seen support at 37.20, 37.40. I believe there were 7 different trading days that bottomed in that range in the last couple of weeks. So that's pretty strong support. We're now looking here at getting up to this level. As I said, the gap would fill at 40.17, and then that trading range up there, more resistance as well. Now, there's another thing that we look at. So I just have this here. So we're still maintaining a core bearish position, at least for now. If some of these things begin to be overcome, some of this resistance, then we'll probably back away from that status. But for now, we're still holding a core bearish position, but we are trading signals around it, as you will see. So one of these is the modified Bollinger Band. So when John Bollinger invented Bollinger Bands, he defined volatility as the standard deviation of closing prices, which seems like a good thing to do, but in reality, the math people, Black-Scholes, etc., use a slightly different definition. It's the standard deviation of daily percentage price changes. So that gives you a different location of the bands. But we, since we're an option firm and we're producing implied and realized volatilities, all that, we need that to be in line with Black-Scholes. Otherwise, it wouldn't make any sense. And so we use those Bollinger Bands, and we draw the plus or minus 4 standard deviation bands. When the market moves outside of those, it's overbought or oversold, setting up a signal. And when it moves back inside, we get the signal. Now, we did notice that we were getting too many false signals from this system. So we put an additional criteria or 2 on it, and that's what we call McMillan volatility bands. So here's the S&P 500. There's only been 3 signals in the last year. First, we had a sell signal up here at the top. You can see this is the plus 4 standard deviation band right there. And inside that's the 3. So you move outside the 4, back inside the 3, that set off a sell signal. Our target for these signals is to touch the lower band, which it did almost immediately, or again there. This one then eventually moved outside and back inside, so that's a buy signal. And that one reached the upper band, a few weeks later, so that terminated that signal. And now we've had another recent signal here. So when we came down to the lows in mid-June, we fell below the -4 standard deviation band, then moved back inside. That was the buy signal right there. And we're still on that buy signal. We're looking for it to get up here to the +4 standard deviation band, which right now is at 40.50, but it can move. Obviously, it moves with realized volatility, and also it moves with the location of the 20-day moving average. So for right now, you know, it's a buy signal, and these have a great track record. The entire track record of these is available on our website with data along with the option strategist newsletter. I'm sorry, I went the wrong way. We offer a service, by the way, if you're interested, where we apply that philosophy to any chart, any ETF, stock, or future, and we email you daily on any stocks, indices, or futures that are setting off new buy or sell signals. You can find that information on our website. So that's everything we do basically with the S&P 500. Let's move on to the next topic, which is the equity-only put-call ratios. Now, we use the equity-only ratios to predict this broad stock market, and that's all stock options that trade. That's what equity-only means. So we're not counting futures options or index options in this equation. And the theory was developed by Marty Zweig back in the 1950s when he was taking the option volume from various ads run in Barron's by the put and call dealers at the time. And he noticed that when there was a lot of put buying, the market then went up. And when there's a lot of call buying, the market went down. So it's a contrary indicator, sort of reflects what the public is doing, or shall we say, dumb money. In any case, so we try to define what too much is. Very simplistically, you know, let's say it's the end of the day, we sum up the volume of all the puts in IBM, let's say, and then sum up the volume of all the calls in IBM, divide the two, that's a put-call ratio. So the put buying generates higher numbers, obviously, since it's in the numerator of the fraction, and call buying, heavy call buying, or increasing call buying, generates lower numbers because it's in the denominator. We use a 21-day moving average, just in case there's something to Fibonacci. And typically, a put-call ratio chart should look like this: inverse relationship between the stock price and the put-call ratio. We post about 1,600 or more put-call ratio charts on our website every day in an area called the strategy zone. So I think we even have a free trial for that. So if you want to take a look at a lot of charts, you can do that. But here's why we use the equity only put call ratio. On top is the S&P 500 index. That's not a current chart. And on the bottom is the equity only put call ratio. And you can see that most of the time this inverse relationship exists. And so that's why we use the equity only put call ratio to predict the S&P 500. So here's the current situation. And you can see that we had a local maximum right here. A local maximum is a buy signal. That was back in mid-May. We got a short rally there, a brief rally, but then we went back to a sell signal, and we've just kind of been toying with this for a while. I drew this horizontal line on the chart because I've been telling our subscribers that if it breaks down below these data points right there, that would confirm the buy signal. That happened yesterday. So this buy signal is now confirmed, and this indicator is bullish. You can see last November, by the way, this says right here that this was the highest this ratio had been since the pandemic trading back in April 2020. You can see how much higher it was than just 6 months ago when we had these very low readings, and a local minimum in the put-call ratio is a sell signal. So sentiment has moved a lot in the last 6 months. Now with computers, we can do a weighted put-call ratio where we take the option price and we multiply it by the volume. And that means we're looking at the dollars being spent on puts versus the dollars being spent on calls. And that, I think, is a more accurate ratio, just because it gets to larger extremes. But it really, the timing is about the same as the other one. So you can see we had a buy signal in mid-May, a local maximum, and then it's been kind of messing around, and now just recently rolled over to a new local maximum, a buy signal, and broke below this level right here. So this buy signal is strong right now. And again, that ratio is the highest it had been since the pandemic. But look, last November, this ratio was the lowest it had been in 17 years. So extreme optimism by traders here, extreme pessimism by traders here. And of course, this is a contrary indicator, so the market goes the other way. So right now we're on those buy signals and everything looks strong from this indicator. We added new positions this morning based on this indicator, new long positions. So what do we trade when we trade these things? Well, I'm in the business of predicting what the underlying is going to do. So I want to buy an option that's going to accurately reflect the underlying. So I look at the delta, let's say of a call option. The delta of a call option ranges between 0 and 1. The higher the delta, the more the option behaves like the stock. So I want something that's going to behave like the stock. I do not want to be right about the stock going up and then lose money on my options. So I like to buy something with fairly high delta. Most of the time in S&P trading, we try to buy an option that's 1 or 2 strikes in the money, maybe with a delta 0.70 or at least 55, somewhere in between that range right there, depending on how long-term out that we're going. So a lot of times on TV, you'll see traders, I don't know if they're really traders, but they're guys that are on TV talking about buying options. They always seem to spread. They buy a call at a low strike, and then they sell another call at a higher strike. And in fact, most of the time, that's the wrong thing to do. It's only correct if implied volatility is high. If implied volatility is low, you're just cutting off your profit potential. And yes, if implied volatility is high, which it sort of is now in, let's say, S&P, then fine, that's okay. But, they'll often say things like, well, you're risking less money. Well, I mean, dollars, yes, but percent, no, they're exactly the same. You're risking 100% whether you buy a call or whether you buy a call bull spread. So why cut off your profit potential? If you're worried about absolute dollars, then just adjust your quantities so they fit in line with what absolute dollars you're willing to risk on the trade. But why cut off your profit potential right here when maybe the stock goes way up and you've just given all that kind of profit potential away? So only spread if options are expensive. And even if you do spread, there's some things you can do to minimize the negative effect of that sold option. One is to spread the strikes apart. So right now in SPY calls, I said we recommended a call spread this morning. So the strikes were 20 points apart. If I'm putting on a put spread right now, though, since puts are more expensive on SPY, I would spread the strikes out 35 to 50 points. And meanwhile, another thing you can do is if the market, let's say you put the call bull spread on, if the market rises to your short strike, then roll the position. What do I mean by that? Well, here's an example. Suppose we started out with SPY at 397 and we bought a bull spread whose strikes were 15 points apart. So we bought the 397 call and we sold the 412 call. Then, later we're fortunate enough that it trades all the way up to our short strike, 412. So at that point, you sell the spread you own, take a profit, and reset up a new spread with 412 as the low strike and 15 points higher, 427 as the high strike. In this way, you're minimizing the negative effect of having that short call out there. And on puts, it's the same thing. So except you roll down instead of up. So let's look at a couple of individual put call ratio charts while we on this subject. One is Qualcomm. Again, a local maximum is a buy signal and a local minimum is a sell signal. So what I've done on these charts, red letters indicate success, blue letters indicate no, not success. And when I'm trading these on individual stocks and futures, I don't take any of the little wiggles in the middle. So like even though that's a local maximum, and that's a local minimum, I don't consider those to be buy and sell signals. I want to be out on the edge of the chart in the 90th percentile or so. So you can see that we've had actually 3 local maximums here in Qualcomm. And even though it did come to a lower low, it gave you another local maximum there. So we are long this in our newsletters, and it has now finally responded with a strong rally to the upside. Here's a more recent one, Dexcom. Sometimes we'll put in a little, look at the chart, see where there's a resistance area, and then only buy the breakout of the resistance area. That's what was happening here. Another one is, another one is Apple. So even though Apple gave the market basically a heart attack on Monday, it's still strong. Excuse me 1 second. Can somebody stop that barking? So in this case, we had a double buy signal, and the second one responded pretty well. And even though we had this hiccup this week, the stock still went straight down. I'm sorry, the Putco ratio went straight down. That's the wrong way again. And then another one we were looking at is ALB. It just gave a buy signal this week, and we bought into that one. And then finally, you can do this with futures options as well. So this is the crude oil on futures options, and not the ETF that represents crude oil, but the actual crude oil futures options that trade on the COMEX. And we had a triple buy signal back then. Those were pretty good. And now we've come down here, we're wavering around with local minimums. That sell signal was, depending where you got in, may or may not have been a winner. But now this latest one in mid-June there has been a very successful sell signal. And we've moved down from there. In this particular case, though, we're trading it with USO options, which are the the ones listed on the stock, like SIBO and those exchanges. So you don't have to have a futures account to trade those. The next topic that we look at is market breadth. And in this particular case, breadth was terrible for a long time. And now it's actually starting to improve. And that's, I think, an overall positive for the market. But breadth is just the difference between advances and declines during the day. And then we actually look at the end of the day. But you can keep that as a cumulative total. So you just keep a running total day by day. Or you can keep an oscillator, and we do both. The oscillator's value is determined as 90% of yesterday's oscillator value, plus 10% of the difference between today's advances and declines. So there's two data sets that you could look at. One is the obvious New York Stock Exchange advances and declines, but that includes a lot of interest rate related issues and some other things that are not necessarily stocks. And so we wanted a stocks only data set as well. And we had a perfect one in all optionable stocks. Now, right now, there's more than 6,000 optionable stocks. So that's a nice, healthy data set on which to calculate advances and declines. So here's the oscillator, the stocks only oscillator using, as I said, only optional stocks. And it goes back here to 2000. So this is, you see all the dates are the same along the bottom there. That's not good. It actually goes back to 2013. And it's up to date until about a week ago. So when you can see, we haven't been oversold. I mean, since 2013, the market's mostly been going up until recently. So it did have, of course, the big sell-off, and that was December of 2018, when right before Christmas, we had a really bad decline. And then again, of course, in the pandemic in 2020, interestingly enough, they were both oversold to about the same degree, even though it seemed like the one in 2020 was much worse. Then this year, we almost got down to that same level in January, and we've been in oversold territory much more often here. But remember, oversold is not being buy. So just recently, we came out of oversold territory, and now the indicator's moving higher, and that is our buy signal. So both our oscillators, New York Stock Exchange and stocks only, are on buy signals right now. So, and the New York Stock Exchange one has been giving a couple of buy signals recently, and we'll get stopped out for one day and come right back in the next day. So we're basically now instituted a rule, at least temporarily, that we're not going to stop ourselves out unless the stop lasts for 2 days. And New York Stock Exchange breadth has been leading the market for the last few weeks, which I think is a good thing, although the market's changed, of course, very quickly on a very, very short-term basis. But right now, New York Stock Exchange breadth has been a little better than stocks only breadth. And that's another kind of underlying positive tone to the market. I mentioned cumulative breadth. Right now, cumulative breadth isn't telling us anything, but in 2021, it did. Both the stock market and cumulative breadth made new all-time highs on June 11th. The stock market went on to keep making new all-time highs all the way through January of 2022, but cumulative breadth didn't. It broke and went down, and so that was a very negative divergence that lasted for about 6 months. So it's just an indicator to tuck away when markets are going up and breadth is not following. That's a warning sign. And not right now. That's not apropos, but it certainly was then. New highs versus new lows. This indicator can't get off the ground. I mean, I only showed through mid-June, but this same series of single digit, this is on the New York Stock Exchange now. That's the number of new highs every day. That has persisted all the way till now. Even yesterday, when the market was up 100 points, there were only 14 new highs on the New York Stock Exchange. So it is in the doldrums, but it will eventually break out of there. I would say it's oversold right now, but again, oversold does not mean buy. Now let's talk about VIX and the various indicators associated with that. So there's a couple of things with VIX that are important. First is the trend of VIX. VIX should be trending opposite to the market direction. And then secondly, VIX will occasionally shoot up and come right back down again, giving these spike peaks on its chart. And those are buy signals for the broad stock market. In fact, that's happened with such regularity over the years that we designed a trading system around it. I'll talk about that in a minute. Again, not apropos and hasn't been apropos really since 2019. But when VIX gets very low, that can be considered to be overbought. I mean, like when it gets down to 12 or so. But that's not a sell signal by itself. It has to remember overbought does not mean sell, just like oversold does not mean buy. So when VIX gets very low, and it will someday again, don't just start shorting the market because VIX is low. You really have to wait for VIX to be low for a while and then begin to rise. And that's when you want to short the market. Anyways, here's the current VIX chart updated through last night. And all those B's on there are buy signals, spike peak buy signals. So let's take the most recent one. It happened right here on June 15th, right there. And then a couple of days later, we had a second one. And I said we have a trading system. So the system is this. Once VIX has advanced 3 points on using closing prices, it has advanced at least 3 points in 3 days or less. It's in what we call spiking mode. Once it reaches whatever peak it reaches while it's in spiking mode and then closes 3 points below the peak, that is the buy signal. So in this particular case, you can see the peak was right there. And then 2 days later, it closed here. And that was the buy signal. It actually gave a second one, but I put that in orange because we don't trade the second one. So we just trade the blue ones, the dark blue ones, or the dark red ones. The red ones were successful trades. The others were not. So this trade, then, the market since June 15th has moved pretty strongly higher through last night. The system lasts for 22 trading days. Yesterday was the 22nd trading day. So we exited this trade this morning, had a decent profit, even with all the expensive options and all the other crazy stuff that's been going on in the market. And we rolled to a new strike, a different expiration, and based on some other indicators. The other thing we look at is the trend of VIX. So the trend of VIX we determine as being where the 20-day moving average is with respect to the, let me erase those lines I just drew. Where the 20-day moving average is, that's right here, the 20-day, and where that is with respect to the 200-day and where VIX is. So if VIX and the 20-day are both on the same side of the 200, so right now you can see that at this point anyways, they were both higher, that's a downtrend in VIX, and that's negative for stocks. So we've been in this downtrend in VIX since all the way back here in December of 2021. That's where VIX, the 20-day crossed above right there. VIX had already crossed above. That was the intermediate term sell signal that's still in effect. And you can see here there are a couple of times when VIX came back below the 200-day, but the 20-day did not. It got close there and back here, but it never closed below it. And so this negative trend has been in effect for VIX for all this time. Now, today, you can see the 200-day is right around 24. That's right there, right around 24. And so if VIX closes below 24, that will terminate at least the sell signal. That will put us in a condition like this one here, where VIX went below, and yet the 20-day is still well above here. It's at 27. It's going to take a while for that to cross below. If the 20-day and VIX both cross below, that would be an intermediate term buy signal, and that would be very strong for the market. We haven't had that, of course, since last December, and the market has struggled. So this is a trustworthy indicator. So just kind of summarize there, we had this buy signal on the 15th. It did expire. I have today, but it really was through yesterday. We're getting out of it today. And the trend of VIX, of course, is remaining negative at this point. I didn't really look at where VIX was currently, but this morning I saw that it was still above 24. So this is something that we follow closely, and if VIX does close below 24 right now, that would be a mild positive for the market, but not a super buy signal. The buy signal won't happen until, as I said, the 20-day crosses below the 200-day. Now, one thing that's been happening with VIX in the last couple of years is that it's stayed pretty high. If you followed VIX over the years, you know that in bull markets, it dropped down to 12, even 10. Very, very low numbers on VIX. And the market in general was strong, but there were some severe sell-offs that happened quickly, like in January of 2018 and, of course, February of 2020. VIX was very low coming into this. So VIX is determined by the pricing of the S&P 500 options that trade on the CBOE, and those are expensive options, and they're traded by big money. Now, big money is not necessarily smart money, but it's usually not dumb money either. So it's trending towards smart money. And so the big money has been keeping VIX high. So last year, even though the market rallied off the 2020 lows and was rallying all through 2021, they never took VIX below 15. This year, even there's been, of course, more trouble, and VIX really hasn't gone below 19. Those are pretty high numbers for VIX, especially considering recent years. And, now this year, the last few months, we've been spent well above 25 much of the time. Now, we never went above 40. We didn't have those crazy moves like in March of 2020, VIX went to 90. We haven't had that in this bear market. And to me, that's an indication that, the market is truly a long-term bear market and not just some spiky thing that happened like the pandemic. But in any case, those high numbers on VIX I cite here at the bottom of the screen were a bit of a warning sign, and VIX is still pretty high considering that the market has rallied strongly here, and yet it's still staying above its 200-day moving average. So big money is still skeptical of this market. That's my point on this. So we can't trade VIX. VIX is a calculation, but we can trade futures and options on VIX. So we can look at the term structure of the VIX futures. So in a bull market, the term structure of the various VIX futures slopes upwards. And we really don't have time here today for me to explain why, but I'll just say my word for it. And the futures will be trading at a premium to VIX. So in this setup, VIX would probably be trading at a number like 10 or 12. On the other hand, if this happens and the term structure slopes downwards and VIX is higher, this happened very much in March of 2020, then that's very bearish for the market. So we pay attention to what the term structure is telling us. So this is the current term structure of VIX futures as of last night. And by the way, you can quote the VIX futures on its a delayed 20-minute delayed price basis on the CBOE website. So last night VIX closed at 24.50. The front month beginning this morning is August, and that closed last night at 26.90. So 90 minus 24.50 is 240. So that's the premium on the futures. And you can see here that for the first 4 months, first 3 months, the futures slope upwards in price out through October. And then it's kind of wavy. I mean, they're pretty flat after that. So this much is positive that they're sloping upwards for the first 3 months. This part is not so positive, but it's flat after that. But it's all at a premium to VIX, so that's good. Not terrific, but good. And we can, if you're not familiar or able to look at the VIX futures, you can look at the CBOE volatility indices. They have 5 of these. There's a 9-day index, there's VIX, which is a 30-day index. There's the 3-month, the 6-month, and the 1 year. And again, you can see here the 90-day is higher than the 30-day, but then after that, they slope upwards. So it's modestly bullish. It mostly slopes upwards, but it's not as strong bullish as you'd see in a true bull market. So the thing that you should watch all the time is the relationship between the front month and the second month VIX futures. So right now, last night on the close, 26.90 and 27.95. The difference was 105, with September being the highest. That's nicely bullish. That's not a problem for the market. But if they invert, and they invert by more than 1 point, you should be heading for the exits quickly, because it has had a great track record, as I said before, February or late January 2018, and also late February 2020. Before the market broke, the 2 front month VIX futures inverted, and that was a very big sell signal. So this year, we haven't seen a negative readings from this indicator very much, certainly nothing like we saw in 2020. And again, it's sort of telling us that, these high VIX prices are probably here to stay for a while, and even more than that, this downtrending market is not a spiky, sell off and rally all the way back kind of market. It's changed from those old V bottom that we saw for years, and now we're more in a downtrending market. A lot of people said, why hasn't VIX gone up to 40 or 50? This is a full-blown bear market, and no one knows for sure. But again, as I said, those S&P puts that would determine heavily the price of VIX. Well, all S&P options do, but the puts tend to dominate the calculation of VIX, and they've been telling us that there's the VIX is not high because a lot of these big traders have been buying these puts all along, and they're not in like suddenly saying, oh my gosh, I have to run in and buy huge quantities of these puts. They've been steadily buying them, so they already have protection in place. And yes, they replace it when it expires, but it's not all of a sudden fire sale, house is on fire, I need insurance, I need fire insurance, that kind of thing. And in addition to that, the out of the money puts are quite expensive in S&P, and so some of the bigger, more aggressive money has been selling them. So that's kept VIX in check. Anyway, to summarize, here's how things stand up right now. We had this VIX spike peak buy signal that just expired. Our breadth oscillators on buy signals, McMillan volatility band buy signal, we saw that. Equity only Putco ratios are also on buy signals, really be in this column. The construct that we were just talking about is mildly bullish. So what's still bearish? Well, new highs versus new lows, the trend of VIX as long as VIX is above 24, and then the S&P chart itself, unless it can overcome some of those resistance areas up to 40.17 and slightly above that, that's still a bearish chart too. So We are still holding on to our core bearish position because of those trends downward in SPX, upwards in VIX, but we are trading those other buy signals around that. I want to show you one last chart. I think this market lines up pretty well with the 73, 74 bear market, and things, of course, go in different directions. They don't always line up all the way to the end, but it's really lined up quite well. In January of 73, the market made an all-time high, proceeded to have a bad January, February, all the way out through July, then had a big rally, then made new lows, and then had this monster rally. So this huge rally right there wiped out a lot of bears because they were short. So there's an old saying that nobody makes money in a bear market because the shorts get caught on the big rallies and the longs just never believe it and keep buying all the way down looking for the bottom. Anyway, this one then eventually kept on going. The oil embargo came in there. The three I's were important back then: inflation, interest rates, and impeachment. Nixon was still president at that time. We don't have impeachment now, but we certainly have inflation and high interest rates. Then when Nixon resigned, the market plunged into its lows. And if you're old enough to remember, Jerry Ford had whip inflation now, win. He issued these buttons and he made a speech to Congress. Lo and behold, the market bottomed on that. Inflation didn't come under control for a number of years afterwards. So I don't know. This shows a year and a half bear market. We could certainly be in the throes of that right now, but we could also be, just about ready to launch on one of these strong rallies, either that one or even more this one. So keeping all this context in mind, it's fine to trade the rallies, but don't fall in love with the market just quite yet. So I mentioned that this website, optionstrategist.com/traders exclusive, we'll have the PDF up there for you to download. Sherry's recording the seminar, and on there you can get a 50% off 1 month to our two main daily services, daily volume alerts and daily option strategist, or 50% off on the option strategist, which comes out weekly. And then we actually have, if you want to try them all, you get 1 month of each of them for $99, and you can take them consecutively. You don't have to take them concurrently. Our track record is posted on the website. Our option strategist 31-year track record broken down by strategy is up there. You may find that interesting reading. And of course, as was said earlier, past performance, no guarantee of future results. We do have a YouTube channel that we post a market comment up there every Monday if you want to take a look at that. And we have a couple of other newsletters too. If you're interested in a more steady conservative strategy, we have a daily put writer where we write deeply on the money puts. And we also have another speculative newsletter just based on special situations, which is going to be looking at earnings trading coming up here. We're entering earnings period here soon. So that pretty much concludes everything. As I said, the website where you can get those discounts is right here. If you're interested in our money management, visit this website and fill out a form and someone will get back to you. So, Sherry, 45 minutes, maybe 46. Back to you.
Very good job. Perfect timing. Oh, look, there's a coupon code there, folks. And I put the link to the special page for us up. It's optionstrategist.com/traders exclusive. So take a look at that, everybody, and I know you're going to love it. And man, that page that's broken down by strategy, that's got to be absolute gold, right?
Yeah, that's not me, by the way. That's who's that, Kevin?
Huh? Didn't you show us a page?
I'm seeing a picture of Kevin.
Oh, okay. I'll tell you what we're going to do. We're going to take this, and I'm going to thank you for being with us. And I will definitely, I will be in touch to invite you back again. Please, I hope you'll come.
All right. Thank you.
Have a good day.
Yeah, you too.
All right. All right. Let's see. Can you see my screen? That was Larry McMillan of McMillan Analysis. I really appreciate his insightful presentations. You've got the link in the discussion so that you can go to his page and take advantage of that offer. I want to remind you that we are going to have a recording of this available, tradersexclusive.com/archived_webinars. And you'll be able to see all of our trading webinars there. There are also some really good articles and videos there that are constantly being updated. Our next speaker is Kenny the Warlock Glick of his, and he's been with us a couple of times. It's been a little while though, so I'm super happy that he's back. Kenny Glick, the Warlock, is a veteran day trader turned educator and founder of Hit the Bid. Kenny has seen all of the major ups and downs in the market and has successfully traded for over 25 years. His practices are simple: actionable short-term opportunities, hedged with risk management, and all confirmed through VWAP, which is going to tell us what that means, although I do know. So let's see. Kenny, I want to make you our presenter.
Can you hear me now?
I can hear you now.
All right,
Okay.
I just got to get my screen share and just waiting to start.
I'm working with one screen today, so nothing is working the way it's supposed to.
Okay.
Second, give me just one more, just
It's
another minute. Bear with me.
the interweb. It's not supposed to work.
You'd think after 2 years of doing this, I'd have it down to a science, but the science is always changing. There we go. All right. Now you would like to see the questions on the fly, I do believe.
All right, show my screen. Let's go. No. You guys see a QQQ chart with a couple of red lines, an orange line, and a blue line?
I see a blue line. I see yellow dots.
You see my faccia brute? That's ugly face in Italian for you guys.
I cannot see your.
Oh no! I wore my fancy jacket for you guys. My trading stock. Hang on a second. Can you see me, or do we have the capability of showing my face, or
Let's see.
I think you do. I'm on top. I'm on top of the screen. You guys see me? I'm hearing feedback. You guys see me?
Okay.
I think it is working. I'll just plow forward, Sherry. It's all right. I think they see me. I think I lost you now. So
I muted myself so that you didn't have to hear any feedback from here.
Oh no,
all right,
we're
good.
all good. Yeah, they see me on top. Hey, what's up, everybody? Good to see you. If anybody doesn't know who I am, my name is Kenny Glick. I go by many names in the industry. I'm called the Abraham of assets, the Baruch of bread, the Cain of cash, the David of ducats, the Elijah of earnings, the Frank of funds, the Glick of gelt, if you Yiddish guys are out there still. I love being called the Warlock. That's my game face. When I trade, I'm very confrontational. I'm very surly. This is a battle for me. I'm a day trader through and through. I've had days when I was a portfolio manager, never liked it. Swing trading never was good for me. Was a big fan of trading options, used to sell premium, loved it. But now that the market became a day trading market ever since the pandemic and the government pretty much stepped in. Again, my theory is that this government really stepped into this market to save us in 2009, and they set this market up to only go up. And it was a very confusing time for me because I'm a bear. I love when the market goes down. I'm always preparing for it to go down. Even when we're going up, I'm always cautiously optimistic. But in 2013, just to jump, again, light years, I've been doing this for so long. Now it's becoming almost hard to sum up my career and how awesome it's been. But 2013 was a moment in time where it wasn't awesome. Is when my arrogance and my belief that I knew more about the market than I did, or that I could outsmart the market, or even worse, knowing what the market was going to do. And I fought the Fed. I wrote a song about it. It's called Don't Fight the Fed. If you Google me, you'll see some music videos. I was a stand-up comedian before I was a trader. Everything I've done has been self-taught. And in 2013, the lessons were learned in blood. And if you've never heard that phrase, lessons not taught in blood are often forgotten. I almost blew my entire career up, my life, my marriage, and my kids. Everything was going to be gone because I kept fighting this market in the face of a government intervention bull market that in 2013 really looked like it was running out of steam, and everything I believed and everything I thought and everything I was taught was telling me I was right. But my arrogance and the idea that I didn't want to accept that I was wrong almost cost me my entire career, 20 years down the drain. And it was pretty awful. And at that same time, I went on a spirit walk. I just said, you know what? I escaped. It was the worst trade, worst 3 days of my career. It would have been the end of it if I wouldn't have sucked up and said, listen, I got to take this loss and get out of this market because, look, you cannot stay short a market that does not want to go down. And that's what we were witnessing from 2009 to 2020. And then the government stepped in the pandemic. But what happened in 2013 is that I was running a website called, well, originally it was called Suck My NASDAQ. You can laugh, it's allowed. We changed it to Hit the Bid because the NASDAQ didn't really appreciate me making fun of their name. And I started just trading in front of an audience, and one guy raised his hand and said, hey, do you use VWAP? And I said, no, I don't care what VWAP is. It really doesn't make any difference to me during the day. And he said, well, your charts are already, you're plotting VWAP and you're plotting multiple time frame VWAPs. And this was a guy named Brian Shannon and Zach Hurwitz. I'll always give credit to Brian Shannon and Zach Hurwitz because they showed me the light that I want to show you guys right now. They showed me that it doesn't matter what you think. It's just what the market is doing. So in 2013, if I was using volume weighted average price for short, VWAP for short, right, I would have saved myself that disaster because VWAP is basically what I've learned is the most important thing you could watch throughout the day. So when these two guys were watching me trade and they said, hey, you're inadvertently using VWAP the way you're trading, why not just let VWAP do the talking? So let me jump back for a second. What is trading, right? What is trading? If you're buying a stock, you want to know when the best time to buy and where the stock could possibly go to, and you want to know what your risks are, right? VWAP does that. If you want to short a stock, you want to know where the best time to short the stock is and where it could fall to. And of course, where, in my case, where the hell you better get out if you're wrong. VWAP does that. VWAP makes trading so simple, it's actually scary. VWAP cuts through the CNBC talking heads that only know how to make money in a bull market. If you haven't noticed yet, you never have bears on the TV. And when they do bring it on, what are they doing? They're ridiculing the bear. They used to bring the guy on who would say, hey, you're still short Tesla? Oh, you're still short in the market? They'd make fun of them. But the market has to come down at some point. And when it's being controlled by the government, and the government was telling us, hey, look, you got to buy the market because we're not going to pay you anywhere else. Zero interest rates, there's nowhere else to put your money, you've got no choice. And the government did a good job, and they created wealth. But sadly, most people aren't in the market. Not as many people as you think participated in this government-induced bull market from hell. Not a lot of people did. So let's fast forward to what we did today, because all I care about is what I do each and every day. I don't swing trade. I don't sell puts anymore. I certainly don't do call spreads, the worst trade ever. Why would you cap your gain on a call. If you're right, be right. Call spreads are awful. Selling puts, yeah, it's a great strategy until it's not. Because when you sell those puts, you better be prepared to buy those stocks. Imagine you was selling some puts on some stocks about 6 months ago that you thought came down. Hey, this Peloton looks good at 80. I'll sell some $70 puts. Now the stock's at 10. Thanks. So what I've learned is that VWAP is a tool of the institutional trader. And who's the biggest institutional trader there is? The government. So VWAP is the government telling you where they're buying and selling stocks, like Nancy Pelosi's husband. We got the inside scoop. We're better than the Pelosi's because we're not criminals. We're just trading the market. So let me show you what we did today. Because every trade I do, especially with options, the minimum gain is generally 50%. We had a 100% gainer today. We had a 400% gainer today, and we had a 600% gainer today. Why do I need to own stocks? I had 6 times my money on one trade, 4 times my money on another trade, and 50% on another trade. Why do I need to own stocks? That would have to be, my stock that I own would have to go up 10-fold tomorrow to match what I just did today. So let me show you. So what we do is we trade options on earnings reports after the stock reports. But why? Don't you want to buy options before earnings reports come out? So if the stock explodes, you're going to make all this money? No. And let me show you, let me just say this one more time. And I'm going to say it 3 more times actually. Buying options into the report is the dumbest trade you could possibly do as a trader. Let me say it one more time. Buying an option, for instance, last night, whether you were bullish Netflix or bearish Netflix, buying an option last night is the dumbest trade you can do as an investor / trader or whatever you consider yourself. Let me explain why. When is the option the most expensive? When the volatility is at the greatest. When is that? 3:59 p.m., a moment before they report. The anticipation. Ooh, what's Netflix gonna do? The option prices are ridiculously expensive. And don't forget, you're guessing. I don't care who you think you are. You don't know what Netflix is gonna do after they report. And even if they report good numbers, you don't know how the stock's gonna react. But what you do know is the next day, how the stock is reacting. So instead of speculating, react. Speculation, no more. Reaction is where you want to be. So this morning, if you see my charts correctly, I don't want to spoil I've already spoiled the second part of the trade, but this is how easy this trade was. So Netflix, they reported good numbers or pseudo good numbers, right? What we do is we just wait for a reason to fade the stock. So fading the stock, what is that? That's anticipating slightly that there's going to be some selling. So for instance, if Sherry woke up 2 days ago and she said, you know what, I'm loving Netflix. And she bought it at 187. And she was brave enough to hold it into the report. And woo! It's up to 214. What's Sherry gonna do? She's gonna cash out. VWAP tells you when more people are cashing out. So you see how it formed this little range. It tried to go down, and got over the VWAP, but then it rolled back over and starts to go down. That's our moment. So this is a confirmation of selling because the stock couldn't stay above the VWAP. And then when it breaks the prior low, after the VWAP break, strap in for this one, kids. When you see this setup, and I've been doing this for a decade, when you see a stock that's gapped up on earnings, that's breaking back below the VWAP and prior lows from the pre-market, 90% of the time, 90% of the time, you get a follow-through move. What more do you need? This trade works 90% of the time. And here's why people get in trouble. And by the way, this is my 7th webinar of the day. I'm running out of caffeine, so let me take a couple of sips. So what we do, right, is we short the stock. And what's so special about this trade is that the risk is clearly defined. Now, what I want you to ask yourself is, Kenny, what's that orange line down there? Great question. Voice in my head. That's the prior day VWAP. And over the last 10 years, and by the way, this is something that was brought to me by Brian Shannon and Zach Hurwitz and my friend Soligello. If you want to follow Soligello, soligello.com. We have found from doing these trades, I don't like calling it back testing, front testing, forward testing, we do the trades, that when a stock that has gapped up, reports earnings, and breaks today's VWAP, which is the blue line, more often than not, you get a follow-through move, and close to 75% of the time, you fall back to prior VWAP. So bang, you've got your reason to short it. You got your area of concern to cover your short back above the VWAP, back above those highs. You're not going to stay short because you just don't stay short stocks that break back over the VWAP. But look what happened. We're short here at 215, and then it breaks down. And just on 400 measly shares, we're covering here. It came back down to prior support. We covered some there. And then we put our stop right here because we're not going to blow the trade. Once we're making money on a trade, you put a stop on the rest. You hope that it's going to go to the orange line, but you always prepare. You always prepare for the stock to go against you, but it didn't. And from 215, where did the stock go to? Right there, right at the open, right to the orange line. My friends, I hope you don't think I drew this chart for this moment. And this is why I'm going to tell you something. I don't sell anything. I'm here to enlighten you. And I'm here to invite you to witness how amazing VWAP trading is. And I'm going to show you 4 or 5 trades that I did today. And again, it's going to be after the fact. And obviously these trades have happened. I'll give you a couple ideas you could throw around for the end of the day. But here's the main point. I don't sell things. People ask to join. I never sell. I don't do email blasts. I don't do alerts. I'm a trader. And I trade in front of a live studio audience since 2007. I invented this genre of trading live with screen shares. It was never done before me and my crew started doing it. We're basically the grandfathers of day trading. If you Google me, you'll see me. I was on 2020 60 Minutes Nightline defending Day Trader Nation. But before we go any further, let me just say one more time. This orange line, prior day VWAP, what this trade proved, again, and the reason I don't sell you anything is that I invite people to my website to see this because it is hard to believe. You should be skeptical. This industry is ripe with fraud, manipulation, and complete tomfoolery. It is the shadiest industry there is. I know. I'm a part of it. I know. I've seen the sausage made. I know the manipulation. I was a market maker. I've seen it being done. You cannot manipulate VWAP. So for the first time, if you only trade using VWAP, that's it. You will never be manipulated ever again. So when they're telling you to buy something on CNBC and you think, well, I like that guy, he seems to know what he's talking about. If VWAP's telling you not to do it, don't do it, because that guy knows nothing. VWAP knows more than all of us. And that's what 2013 did for me. It broke me down, it broke my heart, it broke my soul, and I resurrected my career going back to what I knew worked, which was earnings reports, and now equipped with the tool of the gods. The stock gods have bestowed this tool upon me, where it's the only thing I look at, and it's the only trade I do. So look what we did. After making close to 10 points on the downside, what do we see? Your classic W pattern. I affectionately call it an ass crack breakout because it's funny. The bigger the ass, we call it a Kardashian bottom. And when we see real buyers showing up at prior day VWAP and you get back above that 1 minute, we go from saying, hey, this Netflix was a great short. It's not a great short anymore. Let's buy it. And this time, instead of buying the stock, what do you think we did? The stock's at 205. Let me show you what we did. And if you don't know about this little neat trick, this is Thinkorswim. You put Netflix in this little drop-down menu right here, and it gives you the option chain that's now clickable. So we bought the 207.50s. Watch this, it'll populate on the screen. And you could use VWAP to trade options too. So with just VWAP on your chart, there's our buy. Wasn't a cheap option. $5.75. We paid $6 and $6.25, and we sold them at $8 and $9. Pretty sweet trade. And that's on a stock that we were short in the beginning of the day. And that's what makes VWAP trading another special way of doing this, because it tells you when to get the hell out of the stock. So you can be as bullish and as enthusiastic as you can be, like we were on the QQQ this morning. Let me show you. We're loving the Qs, right? A lot of chop. Oops, sorry, hold on. A lot of chop on the Qs, a lot of crazy activity. And then what happened? We're chopping around, we're chopping around, we're chopping around, we're chopping around. Back above the VWAP, your first reason to buy, but then you broke the high of the day, confirming the bullishness. And what are we doing right here? You're breaking 300, we're buying the 302. So let me show you that trick again. If you're using Thinkorswim by far the best charting out there. When you do come to my website, I do you a favor. I actually show you how to set your charts up. And let me tell you again how I'm not selling you something. Inevitably, I want to sell you something, but I'm not going to have to. You're going to come to my website. It's hitthebid.com. You're going to watch me and my pals trade, and you're going to say, damn, I need to be a part of this. How do I join? And you know what I'm going to say? Hang back. Enjoy your free stay for the next couple of weeks on me. Let me show you how exciting and how profitable this trading can be. And what my real goal is to make you money first. Something that not many people offer. I want to make you the money first. Here's $3,000 that I just made you. Now pay me back and let's go live our lives together. Because I don't do, like I said, alerts, email blasts. You like what you see? You're in. We're like a gang. We're more like a cult, if you really want to be straight up about it. It's the cult of me and the cult of VWAP. And as the leader of this cult, each and every day, to this point still, I am amazed at how well this works. And that's why I say, I'm not here to sell anybody anything. Witness it for yourself. Let me show you how to partake, and that's what you pay for. And you've heard the saying about the phrase, teach a man to fish or give a man to fish he eats for the day. Oh, I'll fish all day for you. Love fishing. Love cooking. Man, I'll make a great halibut. I do phenomenal butter, garlic, potatoes to go with it, with a little asparagus on the side. Ridiculous. But wouldn't it be better to know how to cook yourself? I'll teach you how to fish. And because I've been teaching people how to fish for 10 years, I'm surrounded by 2,000 people daily doing what I do. And every day, more and more people show up, and I do better when you show up. Because let's say 30 more people show up tomorrow, it's my mission in life now to impress you and show you what this is all about, whether or not you join or not. Because my main goal in life is to expose the fraud and expose the manipulation and expose the awfulness of the cheerleading morons like Jim Cramer, who are clueless, and they're always on the wrong side of the market. The two faces of Goldman Sachs. And what I want you to do now, other than learn more about VWAP and come to my website for the next couple of weeks for nothing, what I want you to do is Google Goldman Sachs says no bubble. All right? I'm getting hot thinking about it. Google it. Because on January 7th and the 3 or 4 months prior to this market really tanking, Goldman Sachs was on a mission to convince everybody that we were not in a bubble and that you, the retail investor, had to ignore the fear that you might have had and pile into the market on January 7th, 2022. That's what Goldman Sachs did to you. And what did VWAP do for us on January 7th? If you think you can only use VWAP on a daily basis, let me show you what it did for us. At 399.43, again, you can't see it up there. I can show it to you in a little bit more detail. And again, show up to the website because you're going to be fascinated by this stuff. If you don't know about VWAP, it is the only way to trade, my friends. It really is. It's the institutional money. It's the government money. So while Goldman Sachs was telling us that we need to be piling into the market, VWAP is telling us, this is it. You got to get the hell out of this market. We're about to roll over and die. And it told us to get short the Qs at 399.40 with a 293 target. And look where we went. There's the 293, where we basically took our profits. And as everybody else was listening to Jim Cramer and CNBC and buying into the metaverse, and we're laughing at them and just absolutely confused on how they could be this inept. But there's a point there. They're laughing at you, the retail trader. Goldman Sachs has two faces. The retail, what they tell people, and then what they're really doing. They're telling you to buy while they're really selling. There's a reason for it, because they know they can manipulate people. That's why if you have VWAP, you'll never be manipulated ever again. Let me show you another trade. So right now, we traded Netflix, we traded the Qs, and we traded a stock called Veru. All right? So this is Veru, V-E-R-U. And this is one of our swing trades. And let me just show you why I despise swing trading and I hate owning stocks. This morning, we're loving Veru. Woohoo! Breaking new highs. Yeah, here we go. Oh, wait a minute. It's rolling over and dying. Oh my God, it broke VWAP. Oh my God, it's collapsing. Oh, back above VWAP. Oh, here it goes again. So instead of owning the stock, there's the VWAP break at 1692, and it went to 1840. 1,000 shares, you're up $1,200 right there. And then you're selling into the move. VWAP tells you to sell out of the rest. Okay, cool. You could have actually shorted it, because when stocks are above the VWAP and they break the VWAP, more often than not, you get a follow through move down and almost went to prior day VWAP. You could have made money on the short. And then look what happens. Suddenly it's breaking back above VWAP. You could have went long. But then here's the magic moment. We call it the inverse Kardashian bottom. And I want to show you a neat trick. You see how the stock rolled over and went down? Some people can't see the reverse W. You could put a negative sign in front of the stock. Watch this, VERU, and now you see it as if it went up. So this is why I hate owning stocks, because here I am, an owner of this stock right this second, and everything about this name is a sell and a short because VWAP's telling me so. Because this is called the 1 minute multi-day VWAP reversal. This trade works 90% of the time, and it's absolutely absurd. It's absurd that it works this well. And what's sad about this trade, ironically, is I own it. But the reason and the why I became a trader was, instead of being victimized by pullbacks and bear markets, I said, you know what? All right, if I want to own a few stocks, at least let me trade around them when they are weak. So instead of just sitting here today owning a stock that's going down, I shorted it in my day trading account at $17.80, and it went down to $17.20. I had 1,000 shares. There's my 600 bucks that I made. Now I don't mind owning the stock for another couple of days, because at least I hedged myself and I made some money on the downside. And that's another thing that VWAP will do for you. And again, what VWAP will do for you, it'll open your eyes. You will finally see what the market is doing for real. So one more time, the name implies how important it is. Volume. My 1,000 shares is not moving this stock. I'm an insignificant flea on the back of the institutions. But VWAP is allowing you to piggyback on the institutions. You're that little weird fish next to the great white. Yeah. You are just piggybacking the trade. We're not moving these names, but VWAP is. So when this thing broke the VWAP and then tests it from underneath, that's your confirmation that the sellers are taking the stock over. Why not short the stock? You've got limited risk, and you might as well, because you own it. Why don't you hedge yourself? So one more time, volume. What does it imply? It implies real institutional money. Who moves the market? The institutions. Who's the biggest institution? The government. Who's been running this market since 2009? The government. The government. And what happened to the market when the government stepped back for a couple of months? You got a nice slap in the face of reality. The Qs never should have got to 404. The market never should have went so high. And now we're back to where fair value is at the moment. That's what VWAP provides for you. VWAP is fair value. VWAP is the market. The most important price you'll ever look on any time frame, especially if you're just going to be a day trader, is volume weighted average price. So if I had ability to take some quotes right now, I'd love to. So if anybody, again, I'm running a couple of things here. I don't know how to get. Does anybody have a stock? I don't know if the organizer could get this information to me. I don't have the chat room, because let me show you, please, how it works on any name. So let me show you. All right, one from the peanut gallery. It's Twitter. All right, and here's another one, unique name, because it's in play every day because of the Elon Musk story. Okay, look how beautiful this trade is, right? Sold off at the beginning of the day. We call this the dip and the rip, right? The market's what? Trying to shake people out. You've heard that phrase, right? We also call this a fake out, shakeout, and a breakout. But what you start to notice is, once we got to the blue, you had a little struggle, but then you got to the orange. But now, look what VWAP's telling you. It's telling you this stock wants to go higher because it can't even, look how it's tagged the orange line, tagged the orange line, tagged the orange line. That's confirming strength. So if you were in Twitter today, and again, it was a short first, and then VWAP's telling you this is where the shorts are going to cover, get in. And that's why we're loving Twitter right now, because again, I am not a big fan of swing trading. This is one of mine that I have on right now. And this action today confirmed my bullishness. And I might even do something crazy like hold it into earnings. That's how much I like Twitter at these prices. But I don't know if we can take, if anybody could hit me up with some more ideas, because I would just like to show you how it works on every stock. Every stock, you could trade futures with VWAP, you could trade options, obviously. Well, let's take a look at what the market's doing. I'm going to pick a random stock myself. Let's go BKR. Okay, this is one that we're in right this second. Okay, and why are we in it? It's an earnings report that broke VWAP. We're in it from here, but it broke out of this little range, confirmed its strength right there, and here's where it's unique. Look at the stock. It's down 8%. Why are we buying the stock? Because the VWAP told us to buy it. And look where it went, to the prior day VWAP. Look where we're struggling to get over, the prior day VWAP. Because most trades take place between your 1 minute and what we call the multi-day. So right now, we're still long this name because it hasn't forced us to sell, because our stop is right here. And one thing I like to talk about is, again, little tidbits of information that I picked up over the course of my career. Boring, it's not a reason to sell. You have to be forced out of this trade. And right now, again, this is long-term investing for me. I've been in this stock since 12 o'clock, 2.5 hours. Oh my God, this is long-term investing for me. But there's still been no reason to get out, and I'm looking for it to just get through this area right there. I'm just looking to get paid another 30 or possibly 50 cents. So this one's a live trade for me. I'm still in the Baker Hughes. I'll show you what we got with the QQQ right now. Again, this is an interesting setup for the rest of the day. And if you don't know, QQQ has options that expire at the end of the day. We are, again, I'm not in them right now. I'm hoping to see one more dip. If we can test that 305, that 300 spot right here, and then break over the VWAP. But you'll notice, like, you just came back to the support, broke VWAP, you got paid. Comes back, doesn't break down, you could have been buying again. What time are we at? 2:24. I forgot how long we're supposed to go.
6 whole minutes.
6 whole minutes. Okay. So let's just talk again. If people are responding in the chat room, any quote you want to throw my direction, I will show you how to VWAP it. I could do it in 30 seconds. And again, I love doing, rapid fire, kind of like the one thing I do like about Kramer is when he does the, whatever that's called, the lightning round. Here's another person want to know about Square. Again, dip and rip. You never want to ignore that blue line. Once you get back over that blue line, that dip is over. And what a beautiful trade that would have been. I could show you a couple more of mine. What else did we trade today? Blah, 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 blah. We had the Veru. We had Tilray. Again, this was not any monstrous kind of trade, but let me show you how we did it. By the way, Baker Hughes, new high. All right, here we go. 2.5 hours it's taken me to make something on this trade. Thank God. It's a nice, hopefully this time it doesn't pause for the next 3.5 hours. This stock's been just a snooze fest. But here, this is Tilray. We traded this one. And again, I missed the first move, but when it comes back to test the VWAP, that's a reconfirmed move of the strength. So as it comes off the VWAP, I could buy the stock for $3.79 with a 4-cent risk. And if you get a stock that goes from $3.78 to $4, that's trading. That's making money. And we're still in this name right now. And by the way, let me show you something even more important on the Tilray if you guys want a couple of my ideas. And like I said, I'm not a big fan of swing trading. I'm just so super bullish right now because the bearishness was so strong. I just love being the contrarian. That's why I'm normally a bear. But now these stocks are coming out of some significant downtrends. Okay, weed stocks have been awful, and these are ripe for a little bit more of a squeeze. So let me show you on a monthly basis. It just got over what we call the 1 month VWAP. So then when something gets over the 1 month VWAP, we program our charts to give us 3 months of data. But doof, look what we're about to breach. So we can get over 413, right? Look at where we can go. VWAP's telling us this stock could possibly get squeezed to 575. I'm in. Because if this stock's has the potential right now to go to 575, what's my risk? My risk is 81 is where one of my stops is. That's where we just pivoted from, and this prior day VWAP. So I own the stock right here. I'm in at 390, okay? My stops are basically, you know, again, I have a couple of hundred shares, stop at 382. That's too tight. That's why I don't put that big of a stop there. My main stop is the 366. But when I look at the longer term chart, I'm thinking, hey, this thing could go to 475 tomorrow. So I'm risking $100 to possibly make, and I got 1,000 shares. I'm risking maybe $100 to make myself 1,700. That's risk reward trading. And again, intraday meets the long term. You could use VWAP for both time frames. All right, so let's go back to the QQQ. That's one of our live trades. Again, breaking out of this little tiny range. I haven't added to this trade because I call it reverse greed. I want my price, or I'm not adding. I want another dip. I want to shake people out. I want to buy it down here. Again, we're still in some, but I'd rather see it pull back if I'm going to add to it. If it leaves without me, at least I got something. What else we got going on? QQQ, Twitter, Square, yeah, the Tilray, the Veru. I'll show you another neat one that we love, NNOX, for you guys if you want to follow along. This was a one that we pulled it right out of a yearly chart, coming out of this crazy little bottom formation. VWAP's telling us this one could squeeze to about $17. This one, if we can get over 1465 on this stock, we're definitely going to 17 bucks. I love this stock right here. And one thing I don't know basically the ins and outs of any of these names. I am just technically price only. And when I saw this chart, I was like, I'm in. And that's why I like Twitter. You know, that's why I like Twitter. They just shook everybody out on all that awfulness with Musk and the lawsuit, and the shorts got caught on the wrong side. So now if they have anything positive to say on their earnings report, I think we're going to close this little gap right there at least 43.50, possibly 46. I think this could be a monster move. But let me just go back before I leave you. None of these trades I just talked about, swing trades or some options, everything that we do at Hit the Bid is born out of the day trade. So why am I liking Twitter? I made money on it today. Now I take the house money, right? I take the market's money and I fund my speculation idea. So trade the VWAP for the profits, trade the VWAP intraday, trade the day, live for the day, live forever, and then you take some of that cash and you sprinkle it into these other ideas. So like I said, if you'd like to learn more, hitthebid.com, show up. All you got to do is send us an email. I don't want your credit card. I don't want to know your mom's maiden name. I don't want to know anything about you except your name and your desire to learn more. Show up, hang with us for a couple of weeks. You're digging what we're laying down? Great. We make money for you? Even better. Then, I'm not going to ask you, you're going to want to join us because we got a great bunch of guys, girls, it's, thems, whatever you're into. We're all into everything. We like having fun. We do a Thursday night show where we just drink and party and plan option trades. And if we're not hungover on Friday, we actually do trade. But it's been a really nice ride. Join us. That's all I could say. We're the most transparent bunch of lunatics you'll ever be around. We make money every day, and we're just staying focused. My friends, good to meet you.
Thanks so much. That was awesome. All right. Did we have a link? Did you need me to send a link out anywhere? Or are you just sending them to your site?
Send them to the site, hitthebid.com, and just
Hitthebid.com.
you could, you know what? Email my man. His email we call him the Minotaur. Oh, by the way, if you join our website, you have to have a weird medieval name. On the Warlock, we got the Minotaur, we got Viper. One guy's name's Howard, but we call him Steve just for fun. But yeah, you got to have a weird nickname. But you could email info@hitthebid.com. Somebody will get to you, give you a free pass, and like I said, come and hang out these next 2 weeks. You want to be there because this is my time to shine, earnings season. All right. Good to meet everybody. I love you. Good luck.
Fantastic. Thank you so much for being with us. I hope you'll join us again.
Sure thing.
Have a good one.
You too.
All right. All right. We're moving right along now. That was Kenny, the Warlock Glick with Hit the Bid. Definitely email, go check out the website. And you'll get email back. We'll be following up. Let's see. Let me just come back over here. All right. All right. Now, our next speaker is in the house, Scott Barkley of ProAct Traders, LLC. Just don't forget that you can, if you have to leave early, you automatically get the replay link in your email later, and in the future to listen to this webinar, you go to tradersexclusive.com, then you go to Trader Education, and then go to Educational Webinars, and the replay will be posted there. So Scott Barkley is with us. He's an award-winning Forex trainer who has mentored students. I'm sorry, I am still working with one screen, so it's just really throwing me for a loop here. Things keep popping up all over the place. He has mentored students all over the world since 2003. Scott has had one of his students win the FXCM King of the Mini contest 3 times. One of his students is now the chief trainer for an internationally known global Forex training organization. Quite a few of his students have gone on to be professional fund managers, and some still are clients but have their own hedge funds. Many of his students have been with him since 2005, and the company was founded in 2004. Scott has won numerous awards for his training, especially in Europe. In addition, he's been a guest presenter for FXDD at venues around the world and is a sought-after speaker in Eastern Europe at the university level, even sitting in for professors at times. He's a founder of ProAct Traders, an education and software company that has won numerous awards, including the Best of Round Rock, which is the home of Dell computers. Scott trades and teaches live every day with his students Monday through Thursday in the New York session. Thank you for being with us, Scott, and let me just see if I can successfully bring you to be the presenter. This way. All right, Scott, you should be able to share your screen now.
Okay, hold on.
And I also went ahead and made you organizer so you can see the questions on the fly. And we can see your screen. There, I got green screens.
You got charts there?
Charts.
Yep.
Charts,
Okay.
yes, sir.
All right, let me pull up the PowerPoint, make sure that's showing. And, oh, I'm too far. There we go. All right, we good?
Good job. Take it away, and thanks for being with us today.
All right, good to be here. Hopefully, now, I don't mind where the screen, the mic, the camera's on, but if you want me to shut it off, I'd be more than happy to do that. Because I'm ugly, so let's just shut it off. Anyway, that's me though. I'm a real guy, a real person here, so you can see that. Let me close that up. We stop showing that. Okay. All right. Does everybody hear? Oh, everybody hear me still? All right. Wait a minute. You're hidden webcam, but you're still sharing your webcam. That's weird. Okay. Okay, test. Okay, looks like I'm on.
We can hear you
Hopefully,
good. I can hear you.
okay. I'm not a GoToWebinar guy, so this is all kind of new for me, but there we go. So this is a webinar on finding the wide open space in the Forex for maximum profit. All right. Now, we've been trading the Forex for years and years and years and years and years. Oh, let me do the disclaimer real quick. There it is, so we don't have to read it or anything like that, but there it is. So I've been trading 21 years, trading since 2004. I was a training consultant for FXDD for 3 years with Greg Mikulowski, who's with Forex Live now. I'm currently a daily currency analyst for MarketFi and Invest.com. I was taught by bank traders how bank traders trade. And if you don't know that bank traders manipulate the market, that's what they do. It is not random. All right. I'm a founder of ProAct Traders Charting, software design for traders, by traders, for traders. And I'm in charge of the educational component of our methodology. So what we're going to learn in this webinar is why you need to identify the wide open spaces in the Forex, how to identify those wide open spaces, and it's your only area to trade, how to become a target trader versus a scalper for way more pips. All right, so we keep track of how people come to us, and 97% of all the traders who come to us and stay with us have been trading for 3 years unsuccessfully because they have been scalping. We are not scalpers. What is the correct risk and reward to become a consistent trader, and how to press your winners in the Forex? So we only trade in the wide open spaces. So obviously, if that's the only place you're going to trade, you got to find it. So if you learn this strategy, you can always trade with the big boys. The big boys are the bankers, all right? So hold your questions till the end, and we will get to them when we go to the live charts, all right? So there are many ways to trade the Forex. One is swing trading, one is scalping, one is range trading, one is position trading, and then there's target trading. And that is what we do, right? So in this webinar, we're going to learn how to identify proven areas of, listen, low risk and high reward, right? Learn where to get in and where to get out. Learn how to limit your risk while finding a high probability opportunity for way more pips than you're currently doing, and learn how the dumb money trades and how not to be one of them. By the way, it works in stocks, in cryptos, indices, whatever you want to trade, pork bellies, corn, soybeans, doesn't matter what it is, all right? So let's first understand who the big boys are, because they move the market. And these are the big boys. 2022, Deutsche Bank lost its first spot this year. They always were up at the top. They're no longer there. But if you add the 10 up, you get 70%. And if you add the other 5, you have 80% of the market. All right. So you find their move, and then you find your opportunity, because banks are manipulating the market. The follow through, however, is the other part of the market, all right? The interbank markets are called market makers. Those are the 15 guys I just showed you, all right? They make the market. They make the ranges, the channels, the heart lines, all that sort of stuff. But they do not take the trade to target. They start the move and start the structure. And then the interbank market allows over 1,000 banks to trade between one another, not counting hedge funds and sovereigns. And these banks typically have only 1 or 2 traders per pair in each market. And they execute trades based on the structure of the tier 1 bankers. And some banks allocate between 20 and 30% of their funds in the Forex and generate 40 to 60% of their profits from trading currencies. They make money. If you want to make money, trade with the bankers, okay? They trade price action. They do not trade with indicators, all right? So some of you remember several years ago, Mercedes-Benz, on their annual report, they reported that they made more money trading foreign currencies than they did selling Mercedes-Benz cars around the world, right? So there's a lot of other people in it just banks. Now, if you knew the targets, you would only make great risk for reward trades. And unless you know the target and the stop loss, you cannot assess true risk and reward. So you are not trading, you are gambling. If you knew the targets, you would always trade with at least a 1-to-1 2, or 3 risk to reward ratio. If you knew the targets, you would never trade right into a target and get stopped out and then blame your broker. Oh, the doggone broker stopped me out again. No, he didn't. You traded right into the target because you didn't know where it was. If you knew the targets, you would trade only in the wide open spaces, and you would conserve your margin for the most opportune area to trade. So the question then becomes, can we know the targets? And obviously the answer is yes, all right? So there is no rocket science in the Forex, all right? The Forex is not complicated, but it is complex. There are multiple moving parts, all right? So the big boys will telegraph that in the market. That's why they create a structure, which is why the first thing you do is go look for the structure. So we're going to walk through how to find those wide open spaces, areas of high reward but low risk, and it's not as hard as you might think it is, all right? So I got a chart up here, and you can see that I got a trend, right? And there was a trend up, now there's a trend down, all right? So you must get the channel or trend right first to find the targets, because that tells you direction, right? But as you can see very quickly here, the market moves down and moves back up. Why do they move back up? Because they run out of sellers and they have to go back up. Why do they do that? Professional sellers will never sell at the bottom. Professional sellers only sell at the top. Professional sellers only sell at the top, all right? So this is an ABC corrective move to keep the move to the downside going, all right? So you gotta know direction, and trend in a channel is the first thing. Well, what if you're ranging? We'll talk about it in a minute. So it's important to understand that sustainable trends are just slightly less than 45 degrees, all right? So it's very easy to see. All you gotta do is put your watch up there. If it's 10 to 4 going down, that's 45 degrees. If it's 8 to 2 going up, it's 45 degrees. Anything greater than that cannot be sustained. They will run out of sellers or buyers quicker, right? So that's why the angle is so important. Now, here's what's important. Your trades are unsustainable moves inside a sustainable trend or channel. Get that, right? Unsustainable. That means if it's unsustainable, it's going to stop. Therefore, I have to know where it's going to stop so I don't give back all the profit. All right, so you can see here that I got a little tool. We have a little tool that calculates the Fibonacci sequence. That's what it is. It's just click it and it goes on. It shows you where they are. And you can see here that this is a sustainable move. Right? These are unsustainable moves inside this sustainable move to the downside. And by the way, right in this area here, if you didn't know that that was right there, the S2, that's the second support, you'd have given every bit of it back. Or you'd have traded right into it and you'd ended up with a big loss, and you'd go, the broker stumped me out. Nope, you didn't know where the S2 was, or the S3 or the S4 all the way to S10, right? So we have a sustainable trend or channel, but we have unsustainable moves inside it, right? So let's go back and see where this move started and see how to find the targets, all right? So I put this little tool on. It's a Fibonacci sequence. You can do it yourself, all right? But I have a tool that does it for us automatically. And we can immediately see, all right, that this is the wide open space, and this is the wide open space. These are the two areas I don't want to miss if I'm going down, all right? So the break of one of these, and I'm going to show you how to do fibs and all that sort of stuff here in a minute, all right? The break of a barrier is a commitment to go to the next barrier. The break of that barrier is a commitment to go to the next one, right? So as my friend Greg Mikulowski says, they're going to lean on those lines. Once orders start being placed below the lines, the bankers join them. That's the interbank market, all right? So you can see right here, there was trade one, went right down to target, right down to target. Now, they made an effort to get down to S5, and we're not, all right? So in a live trading environment, we'd also have fibs defining these spaces. I'll show you that on the next slide, all right? Then they pulled back with an ABC corrective move up here, 2 exhaustion wicks and a close and reverse, and down they go, and they go, missed the target by 10 pips is all. 10 pips is all they missed the target by, all right? So, and one thing else I want you to see is as the Fibonacci sequence gets bigger and bigger, so does the space where you can trade, which is more profit for the big boys, but also typically the longer it takes to make it happen, all right? So here we have a trend. I got fibs. I got previous support and resistance on it. and I've got the Fibonacci sequence. We call it an HSI. All right, and you can see how they moved down. All right, they came down, went right to that target. Then there's a wide open space right to the pip to the target. Now, they then went all the way back up because they ran out of sellers. That is an unsustainable move. See, unsustainable. Because it's unsustainable, they got to pull it back. Down they go, another unsustainable move. So they have to pull it back. Another unsustainable move. But where are they going? To the targets, to the targets, to the targets, to the targets. You see? That's what's happening because they all know the targets because they don't trade indicators. They trade price action. Therefore, price is paramount to them, and they know the prices they're shooting for. All right. Now, the banks, the big banks, the tier one bankers have to create this structure so that the interbank boys know what to do. All right. Now, they can't call each other up. HSBC can't call up Bank America and say, hey, Bank America, we're trying to trade this dollar yen down to 111.24. Could you help us? You can't do that because that's called price fixing and you go to jail. Then how did they get everybody to do it? They do it in the charts, which is why you have to learn the language of the charts. All right. So there's a wide open space. Did they do it? Yes. There's a wide open space. Look at, they ran it in 3 candles. Did they run the next one in 3 and 2, a couple of candles? See that? Wide open spaces. All right. The bigger they are, the more participants are going to be there, but the longer it may take. Once you get down to these big areas down here, it could take you 2 days. All right. So your trades are the wide open space. So don't trade into a target. All right, so here's a good one right there, right straight down, right straight down. Okay, here we go up here, right down, wide open space, and this is the bottom. The charts tell you where the bottom is. All right, you can see now immediately here, we're making higher highs, higher lows. It's over to the downside. All right, so here's an up move. All right, we're going to start here. Got the targets plotted up there. You can see where the areas are. Start of a new trend. These are the targets right there. All right, I know them before it happens. I know it before it ever goes. All right, so what did they do? Here's the same trade. What did they do? Right up, right up, right up. Notice it's getting long, takes longer to get up here because of the bigger the wide open space. And finally, there's the top. Look how long it takes to get there. But they don't deter. They go for it. The reason they do that is because this is a 24/6 market. It's actually 24/7, but we can't trade it but 24/6. All right. So what do? They pass the book to the interbank traders in the next session. His job is to keep it going, do whatever it takes to keep it going, and then he'll pass the book to the next guy, and on and on. So they're on a 24-hour cycle. As retail traders, we want the trade to get in a trade and out in 20 minutes or 2 hours. That's all we want to be in the market. Well, guess what? The market doesn't work that way. If you trade like that, you are now trading like the dumb money, and the dumb money loses, bankers win. Bankers are on a 24-hour cycle. And by the way, the vast majority of bankers are intraday traders. They got swing traders and position traders at the bank, but that's a small piece of the puzzle. Everybody trades intraday, all right? So the charts show you where the top is. Took a long time, but they went up there. They were not successful, so they pulled it back with an ABC, which told everybody we're going to target. See? All right, that's why you got to learn the little nuances of what they're doing in the charts, because nothing is random here. That was absolutely manipulated right there, absolutely. All right. And by the way, the pullback is your friend. Now, for most retail traders, the pullback is their enemy. Why? Because they don't know where they're going, so they buy at the top, and then they do an ABC correction and stop you out, and you go, the broker stopped me out again. No, the broker didn't stop you out. He has to do a pullback or the banker does. The broker sells your currency immediately to the bank. So, I mean, your trade. All right. So he has to pull it back in order to get buyers interested in going to the target. And that's why you see the zigzag every single day, up, down, up, down, up, down, as they're looking for buyers and sellers, whichever way they're going. Remember, the bigger the wide open space, the more time it usually takes. All right. So here's a Fedex logo. Can you spot the arrow? And the arrow is right there between the E and the X. Now, if you have never seen the arrow, you will never look at a FedEx box again without seeing the arrow. Once it's shown to you, you will see it. And that's the illustration of what a trade setup is. Once it's shown to you, if you do the work and practice it, you will never not see it again, all right? So to us, it looks like this. It's a momentum follow, which is the follow through, entering the market in the start of a wide open space, okay? So we see close and reverse and close and reverse. Who does that? Tier 1 bankers do that, all right? What are they doing? Close means they close the up and did the reverse. This means they closed the up and did the reverse, okay? Now in our charts, we have momentum and shows it as bright red. We even get a white dot that tells us a big boy entered again, all right? But that's how we see it. We know the bears are in control right there, and that allows us to get in at a really good place as long as we know where the target is. By the way, we never make an entry unless we know the exit. So why do we look for 55 pips? We look for 55 pips as the minimum area for a wide open space. Why do we do that? Because it's part of the Fibonacci sequence. The sequence that we care about in the Forex is 21, 34, 55, 89, 144, and 233. You ever wonder why most of them, the majors are only doing about 90 pips a day? That's because they only have an 89 pip sequence. The bankers are not allowed to trade unless they have 55 pips. So if you have an area smaller than 55 pips, it's you and 4 guys over at Forex Factory trying to push it because the banker cannot make the trade. The average banker is trading 20,000 standard lots. 20,000 standard lots. He can't go into his boss and say, you know, I took 20 pips on this, man. I thought it was good. And he'll say, don't let the door hit you on the way out. You're fired because you risk too much money for too little money of the bank's money. All right. So they're looking for 55. And if they're looking for 55, we're looking for 55. All right. So the sequence, this from the first one to the top right here, that is 55 pips. That's why they can make the turns. All right. So they can do that. All right. Then this was a small area because it's 89 pips from the top, which is the fib sequence. All right. So here we go. Would you have the confidence to stay in a trade that you entered up in here on the turn? Okay. If you knew them in advance. Well, look where they stopped. All right. Then you get the second trade. Look where it stopped. Then you get the third trade. Look where it stopped. You see that? Now, would you know not to trade this signal? I got a momentum signal to the downside. Would you know not to trade that because you're going to trade right into the target? All right. Yeah, I don't want to trade that. There's not 55 pips left. There's 55 from this line. That's why they made it. There's 34 here. They got 55. This is trade 2 for them, by the way. All right. And then we get down here, and now it's 144 pips from the top. Right. They're doing it day in and day out, and they know these numbers. I'll show it to you when we go live. You're going to go, oh my gosh, that's what they do. Of course, that's what they do. All right. So will it work with scary accuracy? Jesse Livermore, very famous trader, stated it this way: the game does not change, and neither does human nature. The visual representation of all the traders, the herd, is represented as candles in a chart. And that is the representation of the human nature of the traders who are trading it. That's why, as you begin the process of trading, you sort of say, man, I keep winning on this EJ. Why am I keep winning on this EJ? I lose like crazy in the pound yen. The reason is that your psychology is more in tune with the psychology of the herd who's trading the EJ, and you're not in tune with those who are trading the GJ. Right? That's how that works. All right. Most of trading, if you get to the end of it and you learn all the technicals and all that sort of stuff, if you ask any professional trader, how long what's the secret of trading? They'll tell you it's stuck between your left ear and your right ear. It's because it's psychology. All right. So bankers are mathematicians and they trade the math. They also telegraph their intentions, which is why the market will constantly do similar things. It's not rocket science. All right. So why do I want to trade this way? All right. Well, at 1-to-1, if I'm trading 1-to-1, okay, I only break even at 50%. If I lose 50% of my trades and I win 50%, I only break even. All right. So when I get down here to 1-to-3, 1-to-2, 1-to-3, at 1-to-3, okay, right here, you can be profitable at 30%. Lose 70% of your trades and you can still be profitable. That's why you want to stack the deck in your favor, not against you, right? So the magic numbers for success are this: 65% win ratio, 35 plus pips average pip capture, You must press your winners without exception. The only way to get to a 35 plus pip capture, average pip capture, is to press your winners. It is the secret in the Forex. You want to know the secret in the Forex? Here it is. Press your winners without exception. That means you've got to find a wide open space of 55 pips or more, or you can't press your winners. All right. So this was a very famous group, a Forex broker, and he did a contest, right? And at the end of the contest, he went and took a look at all the losing accounts and what happened to them. Well, they were right about the trade 64% of the time. Remember, all I got to be is 65% right. They only missed that by 1 pip. Every one of those lost. Every count that he had, every one of them lost because their average pip capture was 5.74. They were scalping 5, 8, 10 pips. All the winning accounts over here, right, they had a slightly better, 6% better win ratio, 70%. But all of them made money. Only one guy won, but all of them made money because their average pip capture was 36.49. 35 is the magic number, all right? These are numbers you need to keep track of as a trader. If you're not keeping track of this, you're not trading, you're gambling. This is a business. You have a P&L in business, you got a 5-year projection, you get all that sort of stuff. You figure out what inventory cost is, all that sort of sales cost. You do that in your business, but when you go to trading, you don't do it at all. Well, I didn't say you, but I'm just saying most traders don't do it. And how will you know what your progress is? How will you know if I'm getting there? You won't. So, what's the secret to success in the Forex? Press your winners without exception. So here's the rules. Never trade more than 2% of your account on any trades not in profit, all right? Divide that amount into 3 units, 3 micros, 3 minis, depends on the size of your account. Never enter trade 1 with more than 1/3 of your lots, okay? So if you divide it by 3 micros, you know that it's 1 micro on your entry, all right? But you can now use 3 times the stop because you have 2% of your account that you're willing to put at risk. Let's say it's $100. So if I have, I could trade 3 minis at 30 pip stops or 33 pip stops, and I have 99 pips, all right? That would not exceed my 2%, all right? But if I trade one mini and leave the 2 alone, all right, I could put a 99 pip stop on that, and I still would not break my rules on margin management. But because I only have 1/3 of my lots in play, I can't make any money unless I add the other 2/3. So the job is to find where am I going to do that. Trade 2 is called the presser, is 2/3 of your trade, and the stops are changed to the max you've agreed to risk. Okay, so you must have a wide open space of 55 pips or more, or you don't have enough room to do it. All right. Use the ATR. I'll show that in just a second. The ATR is the average true range to find today's target. All right. Use entry orders only on trade 2. And by the way, you put entry orders in first. Okay. Then as you approach the target, all right, I'm 18 pips away. Now everything goes to a 1-to-1. All my stops get moved to 18 pips away. I'm 9 pips away. All my stops get moved to 9 pips away. I'm 4 pips away. That's as close as the broker will let you get. All your stops get moved to 4 pips, okay? It pops up 4 pips and you get stopped out. Well, you left 4 pips on the table. You know what happens to your right brain? It goes, oh man, you left 4 pips on the table. No, what you're planning on is risking 4 pips in case it blows through the target, all right? Would you be willing to risk 4 pips on a trade that may go 30 more? Absolutely. That's it. For many currencies, that's more than the spread. So our trade, if we find one, is always filtered by the average true range today. So it's a little tool that we developed, and it shows you how far each currency does statistically day in and day out. It was invented by Wilder, and he uses a 14-day. So we use this Aussie New Zealand, okay? So Aussie New Zealand, it does 75 pips day in and day out. What's its average? 70 pips a day. So that's with 180 days, 6 months worth of data, it doesn't go more than 70 pips a day. So I got a 100 pip target. Is that realistic? No, all right? All right, I'm 10 pips away, but I don't know it's 70 pips. I got 60 pips, man, it's gonna go, well, and then it stops in 10 pips. You wonder why? Because the bankers make the ATR. If the bankers make the ATR, they know the ATR every single day, all right? So if you have 55 plus pips, on the ATR, you may have an opportunity. But in this instance here, 75 pips, if the currency has already moved 26 pips, I don't have 55 pips left. I don't have an opportunity. Well, you've got 43, 53, why don't you take that? Because I have to break a rule, and rule breakers get taken to the cleanups, all right? I can't press my winners unless I have 55 pips, all right? So we're gonna do it live. After all, I may have cherry picked the best ones, or maybe I'm just really lucky. You can ask questions now, and I've got to turn on the questions, which I gotta find. Where are questions? Questions, here we go. Questions, the session's being recorded, and I want questions back. Chat, here we go. Okay, I think I got it up. I'm not sure. I think it's up there. I'll type one to you guys. There I am. All right. All right, so we're going to go live so you can ask questions as we go here. All right, so let me pop over to the charts. All right, these are charts from today. So I'll just start over here. Start over here on the pound yen. All right. So this is the ATR. I'll pull the ATR up here. ATR GJ 199 pips. It does 199 pips a day right now. Its average is 178. Okay. From 5 o'clock, it starts at New York Fix every day. 5 o'clock yesterday, 199 pips is right here. All right. That's the target for today. 199 pips. All right. So there. Now, can everybody see the wide open space and the wide open space? I got 199 pips, so I know I got over 55. I don't want to miss that. Now, we got these little T30s. These are the 34 Fibonacci sequences marked for us. So a break of that is a commitment to go to the next one, which is 60 pips for two of them. See, 55 pips. All right, so you can see there's the wide open space with 1, 2, 3, 4 positions in it to the downside. You take that trade to the downside, trade 1 makes 199 pips, trade 2 makes 169 pips, trade 3 makes 135 pips, trade 4 makes 90 pips, and the last trade makes 45 pips, and you add them up, you got 450 pips. All right, and that, by the way, is actually normal in our room, believe it or not. No, it's hard to believe, but it's true. Oh no, let me get this up. Yeah, move that. Here we go. This is a couple days ago. Pull it up. All right. Should have pulled it up ahead of time. Having to move this go to webinar thing is driving me nuts. Oh, on that one. Hold on. Sorry. Here we go. So this is just a couple of days ago. These are our traders. You can see them pressing their winners, 252 pips net. GJ, look at all the trades there. See, 130 plus 130 still in. See, this is how you make money, folks. You make money. Here's K. Total for the real estate of the month trade so far is 2,882 pips. Does that interest you? It should. So there we go. All right. All right, so let's just pop over here. EJ, same thing, headed to the downside. You can see I got the targets on down here. It's the ATR target. All right, there you go. We are in a live trade on Aussie Swissy. Let me pull over here. All right, so entered this trade this morning. Still hasn't gone, but trade 1 was here. Trade 2 is here. Trade 3 is here. Trade 4 is here. All right, if it goes, we'll be fine. MACD says we're going down. We have some other little tools on here to tell you what the currency's trying to do. I won't get into those today, but let's go take a look at it. Everybody wants to see the euro. It's a piece of junk, but there it is. Peek it up, there it is. Right to the target. Here's the target. We're halfway to target right now. Notice why they had to pull up. They ran out of sellers, so they're going up to find sellers to complete the move. Right? Pound dollar it's headed down. There we go. All right. As you see, we got about 40 pips so far, with three more positions to go in. All right. Why? Because the chart tells you where those positions go in. Let me go over to let's see, dollar Swissie's halfway to target right now. Right there, it's only got about 40 pips, maybe 30 pips left right there. Trade 1, trade 2, trade 3 to the upside. All right. Go to Aussie again. Nothing happening there. Let's go to Euro Aussie. All right. Nothing happening there. The market's pretty dead today. All right. And we're trying to make the turn there off of a rising wedge. Here we go. All right. So yesterday we made a live trade here, and this was the target to the pip, to the target. All right. With 1, 2, 3 positions on to the target. It went 1, 2, 3, 4. 130 pips for trade 1, 90 pips for trade 2, 60 pips for trade 3, and about 35 pips for trade 4. Add them together, you got 300 pips. Wow. There you go. This is the target for today. All right. So it's still trying to go, but it's dead right now. All right. So, okay, let me put the little tool on for the HSI. So once you got a channel built, then you can use this little tool here that we have in our charts. All right. It's nowhere, it's not available anywhere else. So don't send me an email. Can I get it? No, it's on our charts. We built it. All right. Notice to the S1, to the S2, to the pip to the S3, to the S4. New one is the S5 just below the limit. Now, this is why this is important. If I take this trade to the downside and I get to the ATR target for today, I have a major target they've already proven they're using, which is the Fibonacci sequence, just below it and a fib. So what should I do? You want to hold for that trade. That's how you know where it is. What does the dumb money do? They take 5 to 8 pips and they get out. And then they watch as it keeps on going. They don't press their winners. Their average pip capture is 5, 6, 7 pips, and then they blow out of the market and they go, Forex isn't for me. No, the Forex is for anybody. Anybody with average intelligence can trade the Forex, in my opinion. All right. So, over to New Zealand yen. All right. And got a target down here. All right. So see, we're finding the targets, and we won't make a trade unless we have 55 pips. So a lot of times what we'll do is we'll get close, we'll just go down to the target, and mine's defaulted to show me 55 pips, and I'll say, okay, I can trade anywhere above here and to that line. Below that line, I can't trade my first trade. Now, I can trade my second trade if I'm already in. Why? Because my first trade is in profit. All right, so the profit on trade, in fact, that's the whole job of trade 1 is to have profit so that it covers the risk of trade 2. So I trade 1/3 of my lots there. All right, let's just see how we would do it. I'm trying to find the drawer here. If I could find the drawer, that would help me a lot. Here we go. Okay, so let me see if I can draw. All right, so if I take the trade right here, all right, right in here, all right, so I'm going to go down to a 10-minute chart. Hold on just a minute. All right, so I've decided to take the trade here. All right, well, what I got to do is I got to find out where my last resistance was, which is right here. All right, so now that's my risk, actual risk. By the way, it's 5 to 7 pips above that line on an odd number 3 or a 7, and you never use a 5. Why never use a 5? Because option contracts use 5s. If you have a 5 and there's an option contract, and they hit the option contract, they also stop you out. If you have a 7, they don't stop you out. All right, so my actual stop on trade 1 will be 3 times that. So the actual stop will go in here. All right, so trade 1 goes, down it goes. All right, so then trade 2 is going to come in here. Remember, this is 1/3 of my lots. This is 2/3 of my lots. All right, now when trade 2 goes in and starts this move to the downside, this stop and all the stops would have to be moved down to here. Well, what does that do? Trade 1 is in profit. Trade 2 with 2 lots on is break even. And then as I approach this line right here, I go to 1-to-1 risk to reward ratio. What am I holding for? This next fib right there. That's what I'm holding for. All right. So it's pretty easy. It's not rocket science, folks, but learning price action is what takes you the time. All right. Already saw drawings. All right. Learning price action takes time. You can't learn it in 3 weeks, so you just get out of your head. let's go over and see Euro Aussie. All right, Euro, not doing much. There hardly anything's doing anything today. So just oh, you want to see Bitcoin? What's Bitcoin doing today? All right, get rid of that. Now I don't know how to get rid of this thing. Okay, there we go. Bitcoin's just going sideways with a little bit of uplift right there to the upside. XRP, what are we doing? See, if you didn't know that was XRP, you think it was a currency, because everything that we do is done in every single market. Every market does the same thing. S&P 500. All right, there you go. All right. Would you like to know when the money's coming in? Here's when the money's coming in, right here. How'd you like to know when the bears lost control and the bulls got it? There it is. Bears lost control, bulls got it. All right. So there you go. And so you can do, it doesn't matter. Cryptos, anything, same thing works. Doesn't matter what it is. So let me go over and look at that New Zealand dollar. All right, New Zealand dollar is making the flip. Why would that be happening? Because the dollar index is most likely confirmed to the upside. They have. Once the dollar goes up, New Zealand dollar part is going up. That means New Zealand's going down. So you now know, oh, I got to flip the target. So the target doesn't change because it's here from 5 o'clock yesterday and it never changes, all right, because it's the average. All right, so I'm going to flip it to the downside. It's got a 76 pip ATR, and we can determine whether we have a trade here. All right, so we do. Hold on, let me find my drawer again. This is so hard. This is crazy. Where did I lost the drawer? There it is. Okay. I'm used to Zoom, so here we go. All right, so we just got a break. This is called a break and a hook. All right, that's what we want. All right, break and a hook. All right, why do they got to do that? Because they took buys here, and because they took buys here. Remember, when you take a trade with your broker and you say, I want to buy this, he'll sell it to you. You say, I don't want to sell this. He'll let you take that. He'll take either side of your trade. Why would he do that? Because 90% of retail traders fail. 90% of that money's coming to him, all right? And then he immediately, if it's an ECN, he sends it to the bank. Now the bank is willing to do that also because 90% of retail traders fail. How big is the retail market? The retail market is $400 billion a day. What's the U.S. stock market? About 167 billion. So the retail traders in the Forex are 2.5 times the entire New York stock market. Isn't that crazy? And 90% fail. So the banker wakes up every day knowing that 90% of $400 billion is going to flow their way that day. All right? That's because traders don't learn how to trade. They learn to read indicators, which never work. The only indicator has any chance of working and telling you the future is the MACD. Throw every one of them away on your chart. If you're using them, they're giving you false information. All right, studies have been shown on RVI, RSI, slow stochastic, that over a course of a year, they're no better than 50% right. Wow, all right, that's it. Are you going to trust something that's 50% right? I wouldn't do it. All right, so how do we figure the trade? All right, so we know where this is the wide open space. Here's the wide open space, okay? It's got two barriers in it. One is the fib and one is the fib near the end, all right? Now, it's also delineated by the Fibonacci sequence, which is every 34 pips to the downside, all right? So you can see there is 3 trades here. Trade 1 is the market order. Trade 2 is an entry order below the 6,200 here, and you would hold that all the way to the target. All right, so trade 1, 1/3 of my lots, trade 2, 2/3 of my lots, okay? How do we set it up? All right, we erase this and go down to a 10-minute chart, all right? And we scroll this up a little bit, all right? So I'm just saying, here's a close and reverse. That's a good sign. All right, so let's say I want to take that trade to the downside, all right? Where's my last resistance? Right there, all right? So this is my, I'm 5 to 7 pips above that. So this is my actual risk right here. So the stop goes 3 times that. You'd actually figure it out on your calculator. And your stop on trade 1 is up here. All right. Now you can see, in order to get that stop, they would have to take the channel out to the upside and do its ATR all the way up there to get you. Is that possible? Yes. Is it probable? No. All right. All right. So there we go. All right. So now we then would place the second trade below this fib. Let me move this up a little. All right, there we go. All right. So second trade would go below the 6,200 right there. Now, normally it would go under the fib, but because we can't trade into it, only 12 pips to the 6,200. Remember, there's a spread. So on the New Zealand dollar, it's 2 pips. So there's 4 pips of 12 that doesn't even exist. There's only 8 pips there. So you don't trade into a 0-0 number. You trade the break of the 0-0 number. You put 2/3 of your lots there. All right. So you got your initial stop up there. Once this goes down, keeps on going, and once it takes the second trade in, all your stops get moved down to above the 6,200. And you hold now until you get to this fib. And this fib says move your stop. All right, so now you move up and you go right down here, and whatever that is to target, you go 9 pips away, it's 9 pips away. 10 pips away, 10 pips away, whatever it is. All right, so anybody got any questions about all that? It's a little
Hurry up
overwhelming
and
the
ask your
first time.
questions, folks.
Huh?
I say everybody needs to go ahead and ask their questions. We're out of time.
Will it come
How
in
are
on
we
the chat?
going to get in touch with you later?
Go to proacttraders.com. Hold on just a minute. Let me pull it up here. All right. So get rid of this, pop this up, and get rid of the race. Okay. So you come over and spend 10 days in the room, watch traders make hundreds of pips. Maybe you'll catch a few yourself and decide whether we're going to look at each other. We're going to decide if you're a good fit for us, and you're going to decide if we're a good fit for you. All right. It does require a paradigm. Oops, sorry. It does require a paradigm shift for most people because it's just new. That's all. I never traded this way. This is crazy, but I can see people are making money, lots and lots of pips, hundreds of pips. I'm making 5 and they're making 300. Why? What's going on? See? So proacttraders.com, and you can sit, just ask for a demo. We'll let you in the room for 10 days. And, if you go over the weekend, we'll just add some extra days to it. So you get full 10 days in there, and no problem. And, see if we're a good fit. You're going to pick up. Most people tell us that they learn more in the 10 days that we're there than they have in the last 2 weeks, because we go deliberately through each and every currency. Just like I was doing fast today, we go slow. Here's where the trade is. Here's where the opportunity is. Here's the wide open space. We don't trade unless we know where the exit is. Never make a trade unless you know the exit. Now, once that happens, what are you doing? You've already taken care of the reward. So now your only job is to take care of the risk, all right, which is moving your stops. That's it. All right. Well, hopefully it was you picked up something today. If nothing else, maybe you said, wow, there might be another way to trade this. If you're not being successful, you definitely need to come over and take a look, because you might find I may say something in 20 seconds that changes your trading, because it's had us happen before. Oh my gosh. I missed that. So there you go. All righty.
You got a question up here, Scott. Do you plan on having an open house anytime soon?
We'll probably have one in the fall. And in the fall, we open it up to an open house, and we'll have hundreds and hundreds and hundreds of traders in there.
So you want to definitely do this now.
Yeah. So it's it's crazy when we open up an open house, and then we have a mentorship program that's available for traders who are serious, and they say, okay, I want to do a mentorship program, and we have one of those available. We have lots of courses. There's lots of price points to get involved with us. We understand everybody's at a different place in their life, and so we have lots of price points, from very low price points to those who want to be mentored. It's not cheap, but it's also worth it. I have traders with me since 2005, still with me. All right, this is 2022. All right. All righty, everybody. Have a great day. It was wonderful. It was fun. Hope to see you all soon. We'll talk
Thanks
to you
for
later.
joining us, Scott. I definitely will want to have you come back again in this near future. Thank you.
Okay. Just let me know. Talk to you soon.
Bye-bye now.
Bye.
All right, that was Scott Barkley of ProAct Traders. You need to go to his site and check it out. You get 10 days in his room. Just ask to get in, and you're going to see some stuff probably from a new perspective. So our next speaker is here. We know that as a trader, it's your mission to empower yourselves with the knowledge you need to invest successfully, and that's why we've invited our next speaker. He's a trader, an author, and a world-renowned trading expert. He's a former member of the CBOE and the CME. He's a frequent contributor to Bloomberg Business Television, Fox Business News, CBOE TV, and a resource to journalists. He's an invited speaker educating traders for organizations such as NASDAQ, CBOE, the International Securities Exchange, the CME Group, Fidelity Investments, TradeStation, TheStreet.com, the Shanghai Futures Exchange, just to name a few. And he's also a marathon runner, a musician, a world traveler, and a dad. Please welcome Dan Passarelli.
Thank you, Sherry. Thank you very, very much. I'm gonna share my screen. Let's see. Maybe you need to give me control.
I'm bringing it right now. And I think I can make that persona. Yeah, you're already organizing and presenting. Okay, we're good. Take it away, sir.
All right. Well, hey, welcome. And how you feeling today? I'm Dan Passarelli. And thanks for being part of this. Thanks for sticking it out until the end here. I hope to say last but not least, because I've got some really great things to talk about today. Before we get started, I need to point out that options are not for everyone. You should read characteristics and risks of standardized options before trading. Each of us has the power within us to make trading a source of continuous wealth. And today, I'm going to share with you how to unlock that power. This is my promise to you. I'm going to share how you can replace uncertainty with confidence so you can profit consistently no matter what the stock market is doing using this simple, data-driven, real money proven earnings trading system that hundreds of our students have used to go from that demoralized feeling that we've all felt at some point to that feeling of satisfaction and self-assurance that we all know is possible. And that is powerful. You can literally transform your life because when you're confident, you trade better. And when you trade better, you're more confident. It's this positive circle that's easier to experience than you think. The technique that I'm going to share with you makes it possible. It uses my proprietary earnings trading system. And at the end of this presentation, I'll share how you can take the next step so that you can start getting immediate results. Is that a fair deal? Yes? Are you liking this? Hit that questions box. Don't be afraid to participate here. Let's make this fun. Yes, that a fair deal? Let's see here. Ashley says yes. Steven says yes. Oscar says yes. Ida says, found it in an email. Okay, cool. David says yes. You guys are awesome. Okay, good. So in order for you to get the most out of this, I ask that throughout this presentation and afterwards, make this about you. Consider turning off your cell phone, close Facebook, all your other open tabs. If you have a busy household, maybe shut the door to the room you're in and let yourself get immersed in what I'm about to share. Let it become part of you. Let it in. And be sure to stay until the end of the presentation. The most important things I'll share come later. And to keep the focus, I'm going to hold all questions. If you have a question, write it down. I will get to them later. So let's keep positive and let's have some fun. This is a pictorial representation of who I am, what I do, some of the organizations that I've worked with. I've traded for years down on the floor of the Chicago Board Options Exchange. I wrote 2 of the most popular books on option trading. I worked with every major options broker in the US and abroad, as well as pretty much all the exchanges in the world too. And I get to be on TV a lot, which is kind of fun. I guess if you spend enough time in any industry, 29 years for me, you get to do a lot of cool stuff. But enough about me, let's talk about you. I know that some of you have traded options before, and I know some of you have not. Here's the thing, if you've traded earnings specifically with options in the past, I can help you do it better and be more profitable with less risk. If you've not traded earnings with options in the past, then you're in the right place at the right time. because I'm the foremost expert in trading earnings. And those of you who know me, you know that I'm not cocky or arrogant or anything at all like that. I'm definitely not saying that because of ego or anything. I'm saying it because of my experience. And that alone is why you should follow other successful people in this business, because their experience proves they know when and how to take money from the market. And I'm here today to share with you exactly what I look for in this process before I make an earnings trade and how simple it can be. So I'm not shy about saying any of this. Now, I'm also not saying the trading's easy by any means, but I have my strategy down to a simple 3-minute scan that'll blow your mind. I've taken the decision process of whether a trade is worthy of your time and money and energy all the way down to as little as the amount of time you should spend brushing your teeth. And today I'm going to share that process with you. All right, you're going to love this. Would it be okay if I share a short story with you? Hit that questions box, let me know. Would it be okay if I share a short story with you? Ashley says yes. Oscar says yes. Tim says yes. Steven says yes. Dennis says yes. Clifford says yes. All right. So there I am with my little sister. This is probably like 1979 or something. And a lot of kids, you know, they say, oh, I want to be a doctor, fireman, or teacher, whatever it is. For me, I wanted to be a trader, even at that age, which I know it's a little bit weird, right? But I did. I saw traders on TV and in the movies, and growing up in Chicago, there was a lot of it on the local news. I'd see traders in their jackets down in the financial district, and these successful traders were all around me in Chicago. And it excited me to think that they could make money, and good money, trading. So I, right out of college, took a stack of my resumes and went looking for a job. I literally knocked on every door of the Chicago Board of Trade building handing out those resumes, and lo and behold, guess what happened? I got a job. And that's where I got my start. I worked my way up from a runner, which was a totally entry-level position, to becoming one of the biggest traders in my pit. And I started trading in 1998, and life was good. I was living the dream. And at that point, it might have been the best time in 30 years to be where I was. And in a lot of ways, I just happened to be in the right place at the right time. Trading was easy. You could make some mistakes and still make money. Because do you remember what was going on in the markets around 1998? Do you remember what the financial media called what was happening in the stock market around 1998? Do you remember that? Who's going to be first? What was it? I'll give you a hint. The internet. Yes, Stephen got it. The internet bubble is what Stephen says, right? Type a yes if you traded during the internet bubble. Hit that questions box. I'm taking a poll. I really want to know. This is not a rhetorical question. I want to know. Type a yes if you traded during the internet bubble. Yes? No? Ashley says yes. Oscar says no. Timothy says yes. Steven says no. Dennis says no. David says yes. All right. Clifford says no. I'll tell you what, if you are one of the folks who said no, that's okay, because I'm going to share with you an opportunity that you can take advantage of right now that can make you the same sort of gains, and it's just as easy to trade, if not easier. Now, speaking of that old internet bubble, you know what happened, right? In fact, you know what eventually happens to all bubbles, right? That's right. They all pop. And for most, when the internet bubble burst, it didn't really look like this cute little girl who's, you know, like pops the bubble and giggles. Like, it didn't really look like that at all. It looked a little more something like this. This is basically what happened to a lot of people though. And I don't really talk about this a lot, but it's kind of what happened for me. I'd never seen a crash like that in my career at that point. And back then, I didn't know how to handle it. In some ways, I did better than some, but it was bad. All of a sudden, nothing worked. It has worked before. Trades I'd normally crush weren't making money. And I started to lose my confidence. I was constantly second guessing myself. And I will never forget this one time where I just got completely run over by a trade. I lost $500,000 in a single day. That night, I had to go home and have a conversation with my wife, Kathleen. The plan before that was to put my next bonus away for our kids' college funds. And that bonus was gone now. So the kids' college funds were gone now. And I wondered if I'd still have a job. I wondered if I'd be able to keep my house. Everything was suddenly different. So that's when I knew that I had to create a system that works in all market scenarios. And as fate would have it, at that exact moment, I was presented with an opportunity. And it's funny how opportunities seem to come right at the right time, isn't it? And when you get an opportunity, what do you do? What do you do when someone says 1, 2, 3, boom, here's a great opportunity? You take that step, right? I mean, look, there are two types of people in this world. There are those who second guess everything. And those are the people always looking back, not forwards. There are people who hesitate. And then there are people who take action and create success. And from the outside, it looks like these people are always just getting lucky. But that's not it, is it? They take action. Hit that questions box again. Type yes if you're the sort of person who looks forward and takes action. If you take that step, hit that questions box for me. Again, not a rhetorical question. I'm taking a poll. I want to see who is here today. Dennis says yes right out of the gate. Steven says yes right out of the gate. Clifford says yes. Ashley says yes. Oscar says usually. Tim says yes. That's good. That's good. Because you know what? The most successful traders that I know, they all have the same trade. And like, I know thousands of traders. I've been doing this my whole life. The most successful traders that I know all have the same trait, and that is they take action. It's about having an investor's mindset. It's about investing in yourself. Warren Buffett once said the best investment you can make is an investment in yourself. You can't make a profit if you never put that money down and make an investment, can you? So anyway, like many opportunities can, this opportunity that I was presented with, it changed my life and set me down the path that I'm on today. The exchange asked me to come and teach classes for them. And I found that that was my call. At that time, I started trading in a regular non-professional trading account like you. I was learning a different way to trade than I was used to. And I discovered that there were strategies that I wasn't using on the trading floor, or at least not trading them the same way, that were very powerful. That could make money in all market conditions, up or down, even the most unpredictable of markets. I made it my life's work to give back to the trading community and share these strategies with all traders and empower you however I can. And that's what ultimately led me to creating this earnings trading system that I use and all of our top performing traders use. Now let's go back to simpler days. This was pre-COVID crash. This was shortly before then. This is Goldman Sachs, and Goldman Sachs was up 23% over this 12-month period. Question, would you be happy with a 23% return in a year? Would you? Not a rhetorical question. I want to know, I'm going to share the results with the rest of you. Would you be happy with a 23% return in a year? Hit that questions box for me. Clifford says yes. Ashley says yes. Stephen says not really. Okay. Tim says yes. Alex says if I had $1 million, yeah, or not Alex, Daniel rather, says if I had $1 million, yes. Okay. Interesting. Interesting. Dennis says yes, better than 15% is okay. Okay, all right, all right. So this is interesting. And I think some of the folks who were a little hesitant here have an interesting perspective. And you know what? I like it. 23% a year is tough for some people, but what if I told you there's a strategy that it doesn't matter if the market goes up or down, is volatile or calm, and you can still make money consistently and potentially really good money? Well, here's the big news. Traders can do better than returns like these, and you have to. Interest rates are still close to zero, and that's bad for banks. People are worried about inflation and interest rates going up, and the markets are rational, and then that's bad for money managers. But do you know what saved firms like Goldman Sachs lately? Their trading units. Here, look at the screen here. Goldman has 36,600 employees. That's an average salary of $367,564. So they're paying out a total of $13.5 billion in salary, and that salary, that's before bonuses. And bonuses are the big thing for traders. In order for Goldman Sachs to pay out $13.5 billion and then those big bonuses and all the other overhead and still retain enough profits to grow their business by 23%, Goldman must make hundreds of percent each year. These are the kind of trades professional traders make. And that's why they make 300 or 400 grand a year before those gigantic bonuses. When I started on the trading floor, I started with a $30,000 trading account. Making trades like this daily, weekly, and monthly enabled me to turn that $30,000 well into the seven-figure area. That's more than 23% a year. And this is what's possible. This is what traders are doing every day. And it's not just professional traders. This is Vic. He was one of our traders who traded our earnings system a year or so ago. Vic says, I've only been trading for about a year, but 2020 was one of the most difficult years, if not the most difficult year to trade, especially for a newbie like me. In spite of all the challenges, huge market up and down swings throughout the year, and all the crazy stuff happening, I actually did pretty well overall, increasing my account value by over 30% between June 20th when I went live and the end of the year. So that comes out to about a 60% annualized return. And he was brand new to option trading. Imagine what you can do with a little training. So let me start out with a question. Easy one for you, right? If you could consistently make money week after week and month after month, would you trade with more confidence? What say you? If you could consistently make money week after week, month after month, would you trade with more confidence? Steven says, of course. Tim says yes. Ashley says absolutely. Clifford says yes. Dennis says yes. Okay, so right. I mean, that's the intuitive answer, but here's the hard part of that. In order for you to trade consistently, you've got to be trading with confidence. But if you're not trading consistently, how do you have confidence? So what's required is what I call my bread and butter strategies, just my go-to strategies that have been created by somebody who's been doing this for decades, a professional trader. And these strategies are data-driven and tested and proven with real money. And right now, the strongest consistency trade is the earnings trade. there are several advantages to earnings trades. First, they're market independent. We actually don't care if the stock goes up or down after earnings. Interesting, right? They're also very short term on each trade, which limits broad market exposure. If the market's trending higher, I don't care. If it's trending lower, I don't care. There's potentially greatly leveraged profits. There's an extremely simple yes-no test to screen trades, and opportunities are concentrated in a short period of time. Earnings season, right? I mean, there are earnings all year long, but they're more concentrated in what we call earnings season, which is just about a 5 or so week period. But the biggest week of opportunities is next week in 5 days, starting July 25th. And remember that date, July 25th. In fact, write that down. Write down July 25th, and then write, I'm going to be ready. I'm going to be ready. And underline that, because the week of July 25th, next week, is when there are literally hundreds of earnings trading opportunities. I like to call that money week because there's so many opportunities. And opportunities, they're the lifeblood of trading, right? Because it's about having that investor's mentality. You see a good deal and you jump on it. If you don't, you're never going to make it as a trader, right? So we are at the beginning of a life-changing time to trade, right? I've been doing this for a long time. I've been studying earnings for a long time. We are at the beginning of a seriously life-changing time to trade. So when do you want to start getting prepared for that? If money week is in 5 days, you want to be ready for it. When do you want to start? Next month? 3 weeks from now? No. 1, 2, 3, boom, do it now. The best time to get started is now. And the most important thing about earnings trades is simply that they work. And it wasn't until I was a trader, like most of the traders attending this webinar, trading in regular non-professional trading accounts, that I discovered the power of time spreads for earnings. Now, ironically, after trading thousands of time spreads on the trading floor and honing my skills with them, I learned the last 10% nuance that pushed the power of time spreads over the top for me in a rather unique way. So long story short, I found myself on the phone with a producer from Bloomberg Television, and this was going to be, he wanted to interview me down on the trading floor. This is going to be my first time being on global television in front of hundreds of millions of people, right? So I was pretty excited. I said, hey, so what would you like to talk about? And he said, well, look, Dan, Apple has earnings coming out after the close. We want you to share a trade idea for our viewers to trade going into earnings. And then I was like, oh, I was so let down. It was like somebody just like let go of a balloon and all the air came out of it. Because most people don't know this. You probably don't know this. Most professional traders don't trade earnings. Most aren't even allowed to. At the height of my professional trading career, I was one of the top 5 traders in my entire firm as far as profitability goes, right? My risk manager, Bob, he would let me trade anything I wanted, as big as I wanted, because he had that much faith in me. But you know the one thing I was never allowed to trade? I was never allowed to have a position going into earnings. Why? Because that is the most unpredictable day of any quarter, right? And so I'd never really traded earnings before. And for those of you who know me, and I know I see some familiar faces here, or at least familiar names. For those of you who know me, you know that I always put my money where my mouth is. And so if I'm going to talk about a trade in front of hundreds of millions of people, it's going to be something I believe in. It's just a moral thing for me. It's going to be a trade that I have on. So I said, hey, listen, I'll call you right back. I went over to my trading station and I started looking for a trade. And I knew I couldn't buy calls or puts because you can't predict direction on earnings day, right? That's why my system doesn't revolve around direction. Couldn't do credit spreads for the same reason. Covered calls and cash secured puts would be a terrible idea. And I was like, what can I do? And so I, like, last ditch effort, I was like, let's look at a time spread. And it was actually a great trade. I immediately put it on. I did the interview and the trade made money. I was hooked after that. And later I came across some data that you'll hear about in a minute that then gave me the black and white proof that this was no fluke. When the right criteria are met, this is a genuine consistency trade that can be used over and over again to crank out consistent profits with confidence during specific periods of the year, in particular earnings season. So I'm going to give those of you who are not familiar with time spreads about a 15-second crash course, tell you everything you need to know. Those of you who are familiar, hold on for the next 14 seconds. So a time spread is when you buy a longer term option and then sell a shorter term option that has the same strike price. Both are calls or both are puts. Now, the data show that this usually works out great, as you'll see on the next slide, when certain criteria are met. And this is really important. I'm definitely not saying, just go ahead and trade a time spread on every single earnings trade. That'd be a disaster. That would not work. But when certain criteria are met, these work great. The other times we use straddles or some other strategy. Straddles are often weak when it comes to earnings because of the implied volatility buildup leading up to earnings. But when we do our yes/no test, we'll show that there are times, less than 5% of the time, when some other strategy works. Mostly, we're going to stick to time spread. So let's look at why. Now, there's a lot of data here. Don't get too hung up on trying to read all the numbers. Later, I'll explain how to simplify all of this. For now, here's what's important. If you sell short-term options the day before an earnings event, they lose value greatly once earnings are announced the next trading session, which is good because you're short them. Now, longer-term options also lose their value between putting them on the day before earnings and then after the announcement. But the key element of this observation is that short-term options lose way more value than the longer-term ones. So what this means, and what this essentially proves, is that when certain criteria are met, trading time spreads around an earnings event is effectively a long-run, consistent winning strategy. And look, you can see the results here. These are basically the steps to follow this system through earnings season. There are a few details involved, but this is basically the gist of it. So write this down. First, we find all stocks that have options listed on them that have earnings coming out after the close today or before the open tomorrow morning. All right, are you with me? Yes, that is very important. You following me? We can find several trades a day, and sometimes there are hundreds of opportunity. For example, next week, there are literally hundreds. Again, next week's an important week. We screen those trades using the yes/no screen technique to see if we should continue on with the potential trade. And this is your first step and will literally save you hours and hours of your precious time and make your life so much better. Not to mention, it'll ensure that you're only trading the best trades, the ones with edge, meaning they have a statistical advantage in your favor. So your win rate increases and your winners are bigger. Do you like this? Hit that questions box. Give me a yes if you are liking this. Give me a big old yes if you are liking this. Steven says yes, all caps with an exclamation point. Tim says yes with an exclamation point. Ashley says yes. Dennis says yes. Steven says yes. Oscar said yes. Good. So look, then we only continue on with the trades that have a positive term structure of volatility, and the greater the disparity, the better. This step is critical. This is what I did on the trading floor every day, and then put it in our earnings trading system to make this simple for anyone to follow. Next, we run the is-was check by modeling the spread on tomorrow's days with the variant vol crush on both the short-term and the long-term option based on a partial reversion to the mean, but also relative to realized volatility. Then we compare that to the past to get the modeled endurable gap, okay? The modeled endurable gap is just my way of making this completely foolproof and black and white. So it's super easy for you. Once you have that, you'll know exactly which trades to put on and which to stay away from. Now here is where most people go wrong. We put on the time spread the session immediately before earnings. This is less than a 24-hour trade. That is critical. We follow the MTM proprietary earnings trade technique that I just shared, and then exit at the precise time the following day. And everybody screws that part up. But I'm going to share with you how you can get the timing right later. And then just rinse, wash, repeat. So let's go through some examples. This is a trade that a trader could have made in a previous earnings cycle. This was in McDonald's. A trader could have gone through that checklist and all the details involved, and it would have triggered this trade. So a trader could have bought this time spread here by selling to open 10 of the McDonald's 4-day to expiration 165 calls at $1.75. And at the same time, as part of one trade, bought to open 10 of the McDonald's 11-day to expiration 165 calls at $2.11. Sold these, bought these. This is one trade. It's called the time spread. So the market closes, earnings comes out. The next day after the market opens, you'd have to wait for 3 things to happen. And once they do, a trader could have simply entered a closing order by just buying to close the ones he was short, buying 10 of the now 3-day 165 calls, so 129, and selling to close the ones he was long, 10 of the McDonald's now 10-day to expiration, right? Yesterday they're 11, now they're 10, 165 calls at $1.81. So paid 36 cents, collected 52 cents. The trade made 16 cents on a 36-cent trade. That's 44%. Let's make this more tangible. If you bought a 10 lot, you'd have invested $360 and made $160. Factor in commissions, a couple bucks, and that's, of course, a solid trade. Now notice, and this is important, I wanted to make this as black and white as possible. So I assumed the trader was buying the offer and selling the bid for presentation purposes. But in reality, because the bid-ask spreads were so wide, particularly on closing the trade, which is almost always the case, if I'd have used our technique of middling the market, the profit would likely have been a bare minimum of about 20 cents better, which is $200 more on this 10 lot, or more like 100% return in this case. But again, I just wanted to show this example in a pure, unarguable way. In reality, managing the bid-ask spread on closing the trade is one of the parts where most people go wrong. People leave thousands of dollars on the table every earnings season by not doing that part right. The results I show here that are sort of the worst case scenario for this particular trade, they're good, but they can be great. So now I want to make this very realistic and show you exactly how this works in real life when you middle the market with the MTM 2520 middling technique. These are some screenshots of my account on an earnings trade that I made in a past earnings season. This is Oxy. So I went through my checklist and all the details around it, and it triggered this trade. So I put it on by buying to open 20 of the February 22nd 66 calls at $1.49 and selling short 20 of the February 15th 66 calls at $1.31. Paid 18 cents. But look, here's what's interesting. Once I had to buy the February 22nd, they were offered at $1.50, but I didn't pay $1.50. I paid $1.49. I paid less. Once I had to sell, they were bid at $1.30, but I didn't sell them at $1.30. I sold them at $1.31, smack dab in the middle of the bid ask spread. Sold them for more. I mean, really, I should have paid, you know, $1.50 minus $1.30. That's 20 cents, but I paid 10% less than that. I started this trade off 10% better than a typical trader. So long story short, the next day, the market closed, or well, that day, the market closed, earnings comes out. The next morning, I wait for those three things to happen, and I put in my closing order to sell at 30 cents, and I got filled. But I only got filled on 2 of them. Did I panic? No. I have a plan for that. I just keep going through my checklist, move my order down to 27 cents, got filled on the balance, ends up a 51.7% profit in one day. That's about a $279 profit in money terms minus commissions. So, I mean, hey, that first one, you know, made what, 44% or whatever. This one's 51.7%. Man, do all these earnings trades work out exactly that perfect every time? No, there will be an occasional losing trade, and I wanted to share what that looks like with you. This is a trade, again, these are screenshots of my actual trades from my own personal account. The checklist triggered this trade, so I bought the MGM March 1st 29 puts at 91 cents and sold short the February 15th 29 puts at 71 cents. I paid 20 cents. Market closed, earnings comes out. The next day after the market opens, the trade really got away from me. Like, it just exactly what I didn't want to have happen happened. But did I panic? No, because this is a system. You work the system works. So I waited for those three things on my list to happen. And once they did, I put in my closing order and I was able to sell what I bought for 20 cents at 19 cents. So it was a loser, but it was just a 5% loss. I lost a penny on that. And look, I could go on and on. I've made hundreds of these earnings trades. This is Las Vegas Sands. Bought to open the May 3rd 68 calls at 176, sold short the April 18th 68 calls at $1.26, paid 50 cents. Market closed, earnings comes out, market opens, wait for three things to happen, and I close the trade at 70 cents, locking in a 40% profit overnight. That comes out to a $300 profit minus commissions. The key here is consistency, driving consistent results. If you can make $300 on one trade, $500 on another, $280 on another, and there are hundreds of opportunities in a week, right? Like next week, for example, right? Next week, there are literally hundreds of opportunities to analyze and only pick the best ones. And I'm going to lead you through that. I'll tell you about that in a second. How much money do you think you can make trading this system in 1 week, next week, when there are hundreds of opportunities to pick from? What do you think? Again, this is not a rhetorical question. I am taking a survey. I want to know, how much do you think that you could make trading this system next week? Let's see. Tricia says $12,000. Okay. Steven says $10,000. Anybody else want to throw your hat in the ring here? Ashley says $20,000. Tim says $4,000. Okay. And look, this is, it's about consistency, right? We're not talking about making $10,000 on one trade. We're talking about grinding out trades in a 1 week period. And that's also why management is so important. Make sense? Because we got to close these trades at the right time. That's management makes money. That's the 3 M's of trading. Look, here's the bottom line. If you can follow a checklist, finding, analyzing, setting up, and making these trades are simple. Closing the trade simple too. We simply take it off the next day, but that requires a little bit of nuance. And I'll share a resource to make those nuances super simple in just a minute. This is a system, and that's why this is easy. Work the system and the system works. Now, let's talk about realistic expectations, right? You create your own reality. As they say, you make your own luck. You take the actions that make things happen in your life what it is, right? Am I right? And I'm not trying to be philosophical here, but do you believe that's true? Do you believe that the actions you choose determine your future? This is a common trait among any successful people. And if you don't take action, the other side of that, if you do nothing, if you always do exactly what you're doing now, nothing changes, right? Your trading will not change. Profitable trading is a reality for many traders. We have traders in our online community chat room who are some of our top money-making students. They're really successful, regular folks like you and me who post their trades real time for all to see, who have made the decision to be profitable, to simply do it. They just made that choice. And by the way, in a moment, I'll reveal how you can get access to the MTM community chat room for 6 months. All right, here's how to make this work. This is a simple process that anyone can follow, right? But the timing is urgent. Earnings season already started, and next week is when all the opportunity happens. You can make the next week, and consequently the next 6 months, your best of the year, and repeat that success in future earnings seasons throughout your trading career. And you can finally make your trading easy. And man, it is about time, isn't it? This is the total earnings domination, all access premium package complete course. In the complete course that I'm going to share with you, I'm going to show you how to replace uncertainty with confidence so you can profit consistently no matter what the stock market's doing using my simple, data-driven, real money proven total earnings domination system. And in that complete course, here's just some of what you'll learn. How to easily scan the market for earnings trades. Where to get real-time data that pinpoint the winningest earnings trades. The best time of day for entries and exits. That is so important. The yes-no screen technique blueprint that I've been talking about. The earnings time spread risk checklist. So you can maximize your gains and minimize your losses. How to calculate those super important modeled endurable gaps that is at the heart of this entire system. How to manage wide, excuse me a second. How to manage wide bid-ask spreads on closing the trades, and you'll also 100% understand how to know when a stock is more likely to outperform on its earnings announcement, to set up profit and loss targets, and to select the optimal expiration to maximize profit potential. You now have a new opportunity to trade more consistently using a strategy that works in all market conditions, to get a blueprint for earnings trading and watch live trading setups of earnings trades so you can just easily follow along, and how to make the next few weeks your top performing weeks yet. Plus to make back losses on trades that you may have already made that didn't work out. So let's get real here for a second. I'm going to talk about who this is not for, okay? This is not for people looking for a get-rich-quick scheme or gamblers. Yes, it's possible to make a lot of money in a short period of time, but I want to be clear. This is not gambling. This is not guessing. I have done the math. You just follow along. You trade with a mathematical advantage like a professional trader, and it's completely simplified so anyone can do it. This is also not for people who would rather spend time and money and endure losses to learn on their own over many years' time. That's silly. That's not what good traders do. This is the fast track. If you want to spend 3 years figuring it out on your own and losing money in that time, go for it. This is not for you. This is also, that said, not for wishy-washy procrastinators, but wishy-washy people don't make good traders. And that's not you, because look, you showed up today. You showed up today. This is for you. If you want more consistency, this is for you. If you want low risk trades with high profit potential, this is for you. If you believe that your success is tied to following a methodology, and this is for you. If you can follow a few simple steps, this is for action takers. And for my action takers, I am going to make this really easy for you. Okay? This is our total earnings domination 6-month all access premium package. First of all, let me share what you're going to get with this complete class. You begin with the brain dump part of the training, the Secrets to Trading Earnings Bootcamp video. That's right here. I'm going to put 29 years of my experience into your head with one short video. This is the keys to the kingdom. That's a $2,995 value. Why is it $2,995? Because if you can make the kind of money we're talking about consistently on a daily basis throughout this earnings season, and for the rest of earnings seasons this year and forever, this one-time investment can pay you over and over again for a lifetime. And you can see right here that there is no auto renewal on any of this. Now, I want to get you up and running fast, so I created the Total Earnings Domination Accelerator video course. These 3 short videos give you all the information that you need to get started and up and running right away. But we also want you to literally have this mastered. So you're also getting our 4-part on-demand masterclass, earning trading techniques that I learned in my nearly 3 decades on the CBOE trading floor. You'll know exactly what to do every time. This puts the power into your hands. Isn't it important that you make sure that you can put this knowledge to use, that you can actually do it? Well, today you are going to get hands-on training. Starting July 25th, you'll log in and watch me trade live in a real money account, so you'll see exactly what to do as you follow along with me. As I reveal my top picks, you'll literally see the system being traded in the live market, and you'll make your first trade together with me as a group. This is the ultimate hands-on training. This is an all-access premium package for $8,086. But I recently created a couple of bonuses that I'd like to share. To start with, I want to make sure that this works for everyone, regardless of your experience level as an options trader. Even if you're brand new to options and never made an option trade yet, to make sure that this works for everyone, today you're going to get the Options Impact Quick Start video course. This on-demand course levels the playing field for beginner option traders. It covers all the basics you need to begin trading options confidently. Even if you've never traded an option before, you'll be able to start trading like someone who's been trading successfully for years and put you on the fast track to maximize your gains this earnings season. Meet Jill from Cincinnati, Ohio. She joined our class maybe about a year ago, and one of the first trades she did together with us in the live coaching sessions. She bought a Microsoft time spread that met our criteria, as did I and the other students in the class. She bought the spread at $2.65, and in less than 24 hours, sold it for $3.75, locking in a 41.5% profit. And she posted real time in the community chat room, which is what you will have the same access to. Today, you're getting free 6 months of the MTM community chat room. You'll log in and get all your questions answered by me or other coaches. But a huge other sort of secret benefit is that the MTM community chat room is where all our top money making traders log in and post their trades live real time. And this is what one of our student traders who joined us said in the chat room. Jason Fullen from Leander, Texas said, I closed IBM for 85 cents or 124% profit. Opened the trade at 38 cents. And you know what? This was his first total earnings domination trade, a $1,000 winner on his first trade that he made with me and the other students in the live earnings trade class on the very first day. And here's a bonus to help you stand in the shoes of the trader you always knew you could be. Action takers, you're going to get this course that every one of our top traders has gone through. We're going to share live weekly drill down master sessions together. This is the MTM Trade Smart Workshop. Each month, we pick a different topic to drill down on and give you expert understanding of it, so you can achieve mastery as an option trader. Every Thursday of the month, this inner circle group gathers online. The next training session continues the office hours series to get all your questions about earnings, trades, or other trades answered. And for your convenience, these are all recorded. With your password access, you'll instantly get access to the hands-on options adjustment technique series, which is so important. The Gaining Edge, how to dominate the market with simple math series, secrets to better trade fills, so important, and more. This is a $1,794 value. So what this means is today, first you're going to get the Secrets to Trading Earnings Boot Camp so that you can just get that brain dump and get it. Then you're also going to get the Total Earnings Domination Accelerator video course so I can get you up and running right away. You're also going to get the master class so that you can have earnings trading master. Then you're going to watch me trade live for 5 days next week, every afternoon of next week, and I'm going to share with you my top picks. Then as a bonus, you're also going to get the Options Impact Quick Start videos, which is great for beginner traders. You're going to get the MTM community chat room so that you can communicate and learn from our top traders. And you're going to get the Trade Smart Workshop, which is great for advanced traders or beginners who want to start out right. So this is a total package value now of $11,559. But I want this to be a complete no-brainer, completely irresistible, so you can confidently, immediately join us right now. A 1,000,000-mile journey begins with the first step, and this is that step. Go to markettaker.com/TED right now and get all of this for a small, easy investment of just $497. 1, 2, 3, boom. That's market as in stock market, taker as in take what is rightfully yours, 2 T's in a row. Markettaker.com/TED and join us now for a one-time small, easy investment of just $497. That is a massive 96% off discount, and it's valid only for the first 25 of you who take action right now. Now, why would I give such a huge discount? Because earnings season it's already started. And I want you to be one of our 1,000 success stories that we strive to create this year. People who take actions are the ones that can be great traders when you see a great opportunity and fearlessly act on it. So to reward the traders who will move forward, this 96% off is valid only for the first 25 people who join us right now by going to markettaker.com/TED. And for those who join us right now, here's the big bonus. Action takers, you are going to get my proprietary spreadsheet that I created to track all my trades with all the proprietary formulas on the sheet, not protected, so that you can see what they are, that help me make these trades confidently in just minutes. I can't open this bonus up to everyone. I just can't. I can only invite a handful of traders because frankly, like, this bonus is way too valuable. This is a $3,000 value, but this is the best way that I know to all but ensure your success with my earnings trading system. I take this very personally. You are investing in your success today. And by sharing my personal spreadsheet with you, so am I. I'm giving this spreadsheet to traders who take action right now and join us during this webinar before it ends by going to markettaker.com/TED right now. Look, this earnings cycle is one of the most important in the entire history of the stock market. Analysts are waiting to see what the earnings are to give guidance for the future. And that means traders can make more money than they ever have before. This process, it's starting right now. When you enroll today, you'll have just enough time to get through the brain dump part of the training by watching the boot camp, watching the accelerator video course, and so that you can get up and running right away, and the master class, so that you can be ready for the first class this coming Monday, July 25th. These are the 5 most important classes you'll attend this year, probably this decade. This earnings season is the opportunity of a lifetime for those who choose to put that opportunity into action. So it's go time. For those of you who have been waiting for the right opportunity for trading, this is an opportunity to change your life. Also, in the past, because earnings season is just for 1 quarter, when someone joined, they got access for 3 months. But I had some people tell me, but Dan, I have a commitment and you know, I can't make it to all the live earnings classes. Or Dan, I'm gonna be out of town for part of earnings season. So I wanted to make sure everyone who invests in the class was able to fully use it and get the results that they expect. So my team and I decided that with the Total Earnings Domination All Access Premium package, we would make the class available for a full 6 months. So as of today, you'll have plenty of time to get through all the material, and you'll attend the 5 live earnings training sessions in October's Money Week 2. So you're getting double. It's going to be a wonderful refresher come Money Week during October. These 5 hands-on training sessions are all 100% totally live. If you can't make it live, they're all recorded. In each of those classes, I reveal all the top earnings trades of the day, each of those days. And I'm going to prove that anyone can do this, regardless of experience, because the new folks are getting the Options Impact Quick Start videos. But also, I'm going to prove that anyone can do this regardless of account size. So here is my guarantee to you. I'm actually trading these trades live with my own real money, so you can see exactly how it's done and follow along. In fact, I am using less than $10,000 in my account to show you that anyone can do it, regardless of account size. So right now is go time. So I want you to also meet David Z from South Lake Tahoe, California. He said, I closed the last 5 at $1.41, total gain of $425 less commission. The class has paid for itself. And he made that trade during the first week of trading together with the rest of us students. This is Russell K from Glendale, California. He says, I'm above an 80% win rate. Most of the others were maybe a 5% loss. Only 1 total loss out of 16 trades. Like you said, middling is really important and waiting for the bid-ask spread to normalize. Just waiting that extra hour made a few of the trades winners instead of losers. So what he's talking about, what Russell is talking about, is that during Money Week, not only do you watch me on a webinar, on a GoToWebinar, put the trades on while you watch, I show you exactly what to do. But in addition to that, I am in the chat room myself all day long talking about, did these 3 things line up? In Russell's case, some of them didn't, and I said, hey, I'm waiting because not all these things happened. And he also waited and turned some of those losing trades into winners. This is Tyler M from Lexington, Tennessee. He says, I took Dan's MTM course about 7 years ago in college, and it was my first exposure to a structured options trading strategy. He started me down the path that I'm on today. Now I'm a professional trader at a fund. Thanks, Dan. So look, if you're brand new to option trading, today you're getting the Options Impact Quick Start videos to get you up and running right away. You'll watch those first. If you've been trading for a long time, we want you to join us because we take people from this level and we create professional traders. Now, if you want to have results like Tyler and like Russell and like David and like Jill, you have to do what they did and go right now to markettaker.com/TED123, boom. Now, before we move on, I want to welcome some of our new members. Welcome and congratulations to John from Chicago, Illinois. Great job stepping up and joining us, John. Awesome, awesome job. Welcome and congratulations to Stephen from, where is that from? Stephen from South Carolina. Welcome and congratulations to Oscar, all the way from Wyoming. Welcome and congratulations to Tim from New York. Welcome and congratulations to Bobby from Georgia. Welcome and congratulations to David, and I don't have David's city or state or anything like that because of what I'm about to tell you next before I answer the rest of your questions. One question that I get a lot is, Dan, look, I have a small account and I see that this is a great way to grow it, but because it's a small account, I have a hard time coming up with the $497. Is there a payment plan? And that answer is yes. You can use PayPal and PayPal credit. We have a deal with PayPal to offer you both PayPal as a payment option and PayPal credit. So you can lock in total earnings domination today when you check out using PayPal and choose PayPal credit. All you have to do is go to markettaker.com/TED and click the yellow or blue PayPal button and get started right away. And so I'm gonna take some questions. In the meantime, these are some frequently asked questions that I get. Is this live or recorded? Both. I know you're busy. Not everyone can make it during these times to the live classes. You can attend the 5 live earnings trading classes that I mentioned, but if that doesn't work for your schedule live, it's okay. I will record them and you can watch them when it's convenient for you. So those of you who just joined us, you got a username and password in your email. Everybody whose names I just read, and a couple more people just made their way in. You should go and look at your email right now, make sure it's there. If not, check your junk or spam folder. It happens every once in a while. And there is that email to sign up begin watching the boot camp. If you're brand new to option trading, watch the options impact videos first. Get registered for all the live classes, but that is where you will go to watch the recordings as well. Next question I get, how long do I have access to the class? With the total earnings domination all access premium package, you will get an entire 6 months to get these materials. You'll have plenty of time to master this, the system. Is this time consuming? No, in fact, it'll save you time so you can spend it doing the things you love with friends and family. And it can save you years of struggle and foregone profits. Look, you can spend years figuring it out on your own. But right now is the hottest earnings season you are likely to see in your lifetime. You'll be able to go through this simple course now and start seeing immediate results. How do I know I'll be able to do it? Well, this comes with hands-on training. I mean, look, you saw actual screenshots of my account. You're going to watch me trade live in the market, and you'll see exactly what to do with real live trade setups that I'm trading with my real live, real money. And the number one question that I get is there a limit to the number of students who can join? Yes. We have to limit the number allowed in the live component of the package, or else it just gets too out of hand with questions. I want to give each of you my full attention, so we have to limit the number we let in. I have a small team committed to student success. If you're committed to doing your part, we will do ours. And therefore, today is limited to the first 25 traders who are serious about maximizing your gains during earnings season. And this is crunch time. If you're ready to make it happen for yourself, now is the time. The first live training session is in just 5 days. Monday, July 25th at 2:45 Eastern time to 4 o'clock Eastern time. Every day next week at those times, you'll log in, and that is your hands-on training. All right? Everyone who just joined, you're also getting our spreadsheet. You're going to get our spreadsheet shortly before that class begins. Why do I wait until shortly before that class begins? Because frankly, it's too powerful. Like, no joke. That would be like giving a 10-year-old a Ferrari, right? So we're going to wait until right before that class starts so that you have it right there. And you've got to get the knowledge down first before you can trade this. There's not a lot of time that you have to spend, but there's certain things you've got to know before those live sessions. So this is crunch time. This is everything you get. Go to markettaker.com/TED. Join right now and be a part of this time's class. I also want to welcome here Mark from Indianapolis, Indiana. I want to welcome here Gordon from Clearwater, British Columbia. I also want to welcome here Jane from Cincinnati, Ohio. Welcome and congratulations to all you. Like, look, I can't make you successful, only you can, but I've got the resources for you. I've got the classes, I've got the hands-on training, I've got the chat room so that you can be in a community of people who go through the same struggles that you do, and people who have been there and have overcome that you can learn from. I'm going to give you the Trade Smart workshop so you can truly master everything. The accelerator video so you can get up and running right away. All you have to do is go to markettaker.com/now. Now, if you have any further questions, we're gonna end this webinar in just a moment. So if you have any further questions to ask that I can answer to help you make the decision to come and join us and start dominating earnings season, hit the questions box. Now is the time. We've got about 2 minutes before I have to go. I know I stayed a little bit longer But I wanted to make sure that everyone had all the information that they need, because this is important. This is important. Dawn says, when does class start? So, I mean, look, part of these classes is videos. So everyone who just joined us, you literally got a username and password. You should begin watching those videos. Markets closed. If you're watching this real time, you should begin watching those videos today. If you're brand new to options, watch the options impact quick start videos first. Then you can move on to the secrets to trading earnings boot camp. Then I want you to watch the accelerator video course. And if you have time, the master class also. Because the most important part of this is I need you to be in the 5 live coaching sessions with me next week. Again, if you can't make them live, you can watch the recordings. I prefer you're there live so that we can actually make the trades together. So head on over to markettaker.com/TED. I see a couple other folks just joined us. Welcome, congratulations. I'm not going to read everybody else's name, but hey, look, your reward is having stepped up and invested in yourself, right? That's the best skill that any investor can have, is to not have fear, to not be hesitant, to not have to go and ask your mom every time you want to make a trade. You know, when you see value and fearlessly act on it, you are the type of trader that can be successful. You're the type of trader that we want. And that's why I do this. That's why I give you the bonus of the spreadsheet for those who sign up during this webinar right now, because we want those action takers. If we're going to create 1,000 success stories, I don't want the wishy-washy people. Nothing personal if that's you, right? But if that is you, trading's probably not for you, right? Traders are decisive. Traders make decisions. Like I said, if you have to ask your mom every time you want to make a trade, this is probably not going to work for you, right? Not just this, but trading in general. So go to markettaker.com/TED. We're going to jump off the call here. One last thing that I want to say, this was about 3 years ago or so. It seems like an off-topic story, but bear with me. My water softener broke. We have hard water by us. Our water softener broke. And my friend said, don't call somebody to fix it. You can save money. I'm going to help you fix it. And he said, buy it from this discount place and I'll help you install it. Now, I've never done anything like that before, and it turns out that neither is he. So we went down in my basement. When we put it in, we got the old one out. We made a big mess. It took us probably about 8 hours to do, wasted an entire day. Turned out we hooked it up wrong and the thing broke, and I had to call and get a new one and then have somebody who knew what they were doing do it and just get it done. There's this thing called penny wise and pound foolish, right? There's the smart way to do things and the cheap way to do things. And the cheap way to do things is sometimes not what you think. Sometimes what you think is the cheap way to do things is the much more expensive route and much more time consuming route and much more frustrating route. And a lot of traders that I know, there's a small percentage of traders who just have to beat their head against a wall for enough months or enough years and have to lose enough money for enough months or enough years and enough dollars. And sometimes that's in the tens of thousands of dollars before they just come and say, Dan, can I sign up? Show me what to do. Make this easy. So I'm going to make this really easy for you. Go to markettaker.com/TED, go through the boot camp, go through the accelerator course, get signed up for the live classes, and by the end of next week, you are going to have this system mastered. Thanks for spending your time with me. Welcome all the folks who just joined us, and everyone else. Hey, I hope that this was very useful to you. I laid out a big part of my system. If you want to make it easier, last chance, go to markettaker.com/TED, and I'll make it super easy for you. That said, have a great rest of your day. Trade smart. I'm Dan Passarelli. See most of you guys in the live earnings trading sessions. Bye.
All right, I'm not sure if anyone can hear me. My internet and electricity is bumping in and out. I hope everybody had a great time today. Thank you for, this has been a presentation of tradersexclusive.com. You can see us on Twitter at options_info. And of course, always go to tradersexclusive.com. Thank you for being with us. I hope you'll join us again on August 3rd when we have our next 4 professional expert traders joining us to help you learn more about your trading. Thank you and have a good day. Trade well.